Pronto? Sì, ci siamo. Tra 2 minuti, ma tu... Aspetta, dico iniziare lo streaming. Gliel'ho mandato. Sì, ce l'ha.
No, si collega o viene direttamente oppure si collega comunque io ho visto che è andato, sì, ma io ne parla, 55, quindi sarà per me.
Gli mettiamo questo. Edward, thank you. Start. Ah, siamo pronti. Appena arrivano.
Ok, sicuramente mi raggiungo con la famiglia più volte che mi porto la famiglia oppresso. Comunque ci devono. Sì, certo.
Già attivo. Allora, grazie a tutti.
Allora, buongiorno, grazie a tutti per essere intervenuti oggi a questo importante convegno e volevo ringraziare ovviamente Renato Giovannini per averlo organizzato e tutti gli altri partner della LUIS e anche GMG Capital. Adesso scusate ma cerco di fermarlo un attimo. Allora, distinguished guests and colleagues, it is both an honor and a privilege to officially open the workshop held today at Guglielmo Marconi University. This event results from a fruitful collaboration between our department, the Arcelli Center for Monetary and Financial Studies, and GMG Capital. Its purpose is to address some of the most pressing and strategic challenges in contemporary finance: sustainability, integrated risk management, and the evolution of valuation models. We are living in a pivotal moment. The transformation of financial markets, driven by the energy transition, geopolitical instability, digitalization, and environmental urgency, demands a profound rethinking of how we assess risk and value. In this context, ESG factors, environmental, social, and governance, are no longer peripheral ethical considerations, but essential drivers of long-term competitiveness and systemic resilience. It is no coincidence that the world's leading financial institutions, from the European Central Bank to the International Monetary Fund, from the BlackRock to Goldman Sachs, and major asset managers like Vanguard and Amundi, have now fully integrated ESG metrics into their decision-making process, asset allocation strategies, and portfolio assessment. The IFRS Foundation, with the establishment of the International Sustainability Standards Board, is working toward global convergence on transparent and comparable ESG disclosure standards. Meanwhile, international bodies such as the OECD, the United Nations, and the European Commission, via the Green Deal and the EU taxonomy, are reshaping the regulatory and economic framework for sustainable investment. And yet, alongside this global framework and guidelines, a fundamental question remains, which is how to translate ESG complexity into robust, replicable valuation models that effectively mitigate the risk. This, in a sense, is the core mission of today's workshop. Our speakers will explore cutting-edge methodology for developing ESG scoring system, risk-adjusted loan pricing, the impact of green bonds on firm performance, and market confidence in sovereign debt issuance, aligned with sustainability goals. We are particularly honored by the presence of Professor Edward Altman, one of the world's foremost experts on credit risk and quantitative finance, whose keynote will address the dynamics of the leveraged credit cycle and the rise of private debt markets. Through the day, we will also have valuable insight from banking professionals, research institutions, and universities pioneering innovative approach to risk evaluation. With this event, our department reaffirms its commitment to an academia that engages with the real world, interdisciplinary, internationally connected, and dedicated to producing knowledge that meets the evolving needs of our economy and society. In an era where markets are increasingly exposed to climate shocks, regulatory shifts, and changing investor behavior, the ability to foresee and price risk is not only a competitive advantage, it is a collective responsibility. I conclude by expressing my heartfelt thanks to all our speakers, to the organizing committee, and to our scientific partner, and to Renato Giovannini that wanted strongly this event at Marconi University. I wish you a productive and intellectually enriching day.
Thank you, Andrea. Thank you so much, Andrea. Don't worry. See you later. Thank you so much. Thank you. We wait for you later, yeah, for the coffee break too. Thank you. Thank you. Thank you to all. Thank you to Andrea. And now we can start. Only 1 minute because we are late. So by my side today, today's themes, managing SG, market and credit risk, reflect a timely and crucial challenge. How to balance sustainability, financial performance, and systemic resilience in an increasingly complex environment. The question in our title is, of course, a reference to energy, but here it became a metaphor for the powerful interaction between SG, market force, and credit risk force that are refreshing both global finance and corporate behavior. And we are honored to host leading scholar, professional, and policymaker who will help us to explore these dynamics from the quantitative modeling to strategic application in sectors like banking, infrastructure, and public finance. Let me thank all the speakers, and especially to our special guest, Professor Edward Altman, for being here today. So we can start with the thank you to all. We can start with Francesco Baldi. Please, Francesco, you can start. Yeah. Oh, you want to stay? You have the. Ok. Dovrebbe essere acceso quello. Thank you.
Okay, thanks a lot. Okay, this is a joint paper with Professor Altman and other two colleagues, Claudio Di Polito and Antonio Salvi, and it's a paper on which aims to adapt and to extend the Z-score model that was developed by Professor Altman in 1968 to the ESG space, to the ESG context. So the idea is very simple. Instead of using financial ratios, which are the key variables of the well-famous and well-known Z-score by Professor Altman, we replaced financial ratios with the most widely known indicators of ESG performance. That's the idea. We all know that the investment process worldwide is guided by ESG ratings. Indeed, a third of assets under management globally, amounting to 30 trillion, are now subject to ESG criteria, are driven by ESG criteria. And so ESG ratings providers, such as rating agencies, play an increasingly important role in the investment process globally. What do ESG rating agencies do? They collect and evaluate ESG data to produce ratings, with the objective of measuring the ESG performance of a company, the ESG compliance or the ESG performance of a company. What do we mean by ESG performance? How well a company is managing environmental, social, and governance risks and opportunities. So ESG performance is a sort of a summary or measure of a non-financial, or of a company's non-financial performance. Now, ESG ratings work very much like credit ratings, okay? So ESG ratings try to assess the ESG performance of a company, while credit ratings assess a company's creditworthiness, but the two concepts are fundamentally different. The ESG performance is still an ambiguous notion, while a company's creditworthiness is clearly defined as the risk of default of a company. And ESG reporting is still in its infancy, while financial reporting standards, of course, are fully harmonized and have been fully developed over the past decades. Also, current research has highlighted a strong divergence of ESG ratings. Okay, so ESG, because there is no common methodology being employed by agencies as it has been so far for credit ratings. Research has noticed a very strong divergence of the several ESG ratings that have been produced in the market so far. This is the context. In this context, the purpose of our paper is to propose a novel, unique ESG rating metrics to measure the level of ESG performance or ESG compliance of non-financial firms. And for this reason, we concentrate, so our sample consists of firms headquartered in Europe and listed in European stock markets. Why Europe? Why? Because, as we know, the European Commission has recently approved a massive ESG regulator package, including the Corporate Sustainability Reporting Directive. And indeed, a portion of our model is based on the key principles of the Corporate Sustainability Reporting Directive. Why? Because the effort from the European Commission is to promote a transition to a more sustainable economy. Indeed, the European institutions have set climate as an objective to reach climate neutrality by 2050. Yes.
You might try this with the microphone, and if you want to speak in Italian, that's fine too. Because, I know this stuff already.
Okay, no problem.
Maybe the audience would prefer Italian.
Okay, what do you prefer? Do you prefer English or English? Okay, perfect. Okay, so we developed a novel, unique ESG rating model that exploits the logic of the Z-score by Altman. Okay, the objective of the Z-score by Altman, 1968, was to estimate a company's probability of default using a set of explanatory financial variables, so financial statements variables. We borrow the same statistical techniques underlying the Z-score by Altman. So we, as we will see later, we used multiple discriminant analysis and to confirm our results, the logistic regression. But instead of using as explanatory variables, instead of using financial statements ratios, we use leading indicators of ESG performance. For this reason, we named our model the Z-ESG rating model and the outcome the Z-ESG score. Just to give you just to motivate the study, I cited a few literature references. We followed the suggestion by Chattery that says that efforts to develop common measurement systems may lead to an improvement in convergence of ESG ratings. We respond to the call for more work on the development of proprietary ESG ratings by these researchers, Bert Kolber and Roy Grigobon, which are that have been massively cited recently because they discovered this strong divergence of ESG ratings. They say that researchers should invest more in developing their own specific metrics and make them available to others. And that's what we do. That's what we do in this paper. So our study makes at least two contributions. We developed a novel and simple ESG rating by relying on the notion of the Z-score, trying to measure the probability of a firm being ESG or non-ESG performing. And we offer investors an easy-to-use and replicable ESG rating model fueled by ESG data to assign an ESG score to a firm. How did we construct the model? We built the model through 5 steps. Step 1 was the selection of the sample. Step 2 was the administration, the design and the administration of a survey to the sample companies. Step 3 had to do with running a stepwise regression analysis to select those indicators of ESG performance that correlate most with our Y variable, with the degree of ESG performance of our firms. Step 4 was indeed the performance of the econometric analysis, and step 5 has to do with the development of a Z-ESG rating matrix. Essentially, we convert the Z-ESG scores into agency equivalent rating classes to make the scores more easily understandable and in line with the business practice of having ratings to assess such types of phenomena. So step 1. We retrieve ESG data for 1,341 small, medium, and large size companies listed in the European stock markets from the former Refinity, from the LSEG workspace in 2022. And we only selected those firms for which the most recurring ESG indicators used by the major ESG rating agencies were available in the database. Okay? And so this procedure yielded a sample of 325 European listed, mostly large-sized firms. Okay? Why? Because for several small and medium enterprises, these indicators of ESG performance are not available. So our final sample consists of 325 European listed firms. This is the geographic distribution. 49 companies are operate in France, 39 in Italy, 44 in UK, 35 in Germany, and so on and so forth. This is the breakdown of the sample by the economic activity. 54% of the firms of our sample operate in the manufacturing sector. 7% of these firms operate in the mining sector, and less than 7% in the energy sector. So these are non-financial firms, mostly manufacturing firms or service-based firms. The second step was the step that allows us to discriminate between ESG and non-ESG compliant firms. And we did so by designing a simple survey of 10 yes or no questions chosen on the basis of the key principles of the CSRD. Okay? 10 questions, 10 yes or no questions, such as: does the company prepare a sustainability report based on the GRE standards? Is the company assigned an ESG score? Does the company have a sustainability manager? Does the company have an ESG committee within its board of directors? So 10 easy questions whose answers is yes or no. That allows us to capture this obscure very much obscure phenomenon, which is ESG performance or ESG compliance. And the companies responding yes to at least 6 out of 10 questions above the median were classified as ESG compliant, while those responding yes to less than 6 out of 10 questions were classified as non-ESG compliant. So the first subsample was assigned value 1, being ESG compliant, and the second subsample was assigned value 0, because they were non-ESG compliant. So our Y variable is a dichotomous variable that takes the value of 1 if the firm is ESG compliant, and the value of 0 if the firm is non-ESG compliant. So that was the procedure that allows us to transform the Y variable in a similar way as the y variable of the z-score by model, sound, firm, or likely to default, is the dichotomous variable, taking the value 1 if the firm is sound, financially sound, and 0 if the firm is distressed. The third step was a stepwise regression analysis that allowed us to choose among the indicators, the most recurring indicators used by ESG rating agencies, those that are the most effective to measure a company's ESG performance. And the stepwise regressions indeed yielded a total of 39 independent variables that correlate the most with our Y variable. And these 39 independent variables were grouped into 3 categories: 13 variables for the environmental category, 13 variables for the social category, social pillar, and 13 for the governance pillar. All these independent variables are based on publicly available information, based on sustainability reports, corporate governance documents, code of ethics of all these firms included in the sample. So what are the key 39 variables that we chose as explanatory variables? For example, the ratio of CO2 emissions to total revenues. And we expect a negative sign for this variable, because as the CO2 emissions increase, the lower the ESG performance will be for a company. Or if the company has green buildings or not, if the company cares about biodiversity risk or not, if the company uses renewable energy or not, whether the firm provides smart working hours to employees or not, whether the firm, how many board members are female in each firm, or how many independent non-executive board members are included in the board, and so on and so forth. So the best of the best in terms of ESG performance indicators being used widely and globally by the leading ESG rating agencies, chosen through a stepwise regression analysis. Then step 4 was had to do with, so we ran, in step 4 we ran indeed an econometric analysis based on 2 econometric techniques. The MDA, the multiple discriminant analysis that was originally chosen by Professor Altman in 1968 for his seminal article, and the the modern version of the discriminant analysis is the logistic regression, which allows us to transform the z-scores into probabilities, essentially, ranging from 0 to 1. What is the idea behind the discriminant analysis? Essentially, we have two groups known a priori, the group of ESG compliant firms and the group of non-ESG compliant firms. The model should try to best predict which companies belong to either of the 2 groups. Okay, so the idea is that we should try to select a linear combination, a set of variables linearly combined to score the firm, to give a z-score to the firm. A linear combination of independent variables that is able to minimize the probability of misclassification, of misclassifying the firms through the model. In doing so, the model obeys 2 criteria. We want to maximize the distance between the average z-scores of the 2 groups, so that the 2 groups are very distant from each other, and we want to minimize the variance of the z-scores in each group. Okay? So indeed, once you estimate the V1, V2, Vn, the coefficients, then you can apply these coefficients to give a score, ZESG score, to any margin of any new firm by simply allowing the firm to answer the 39 questions, answering the 39 variables. So each variable will be multiplied by the coefficient, and so you will have a ZESG score for the firm. So these are the results. We ran 3 MDA, 3 discriminant analysis models for each pillar, 1 for each pillar. So as you see, so the discriminating power of the model is given by the Wilks lambda, which ranges from between 0 and 1. 1 being meaning no discrimination and zero total discrimination, so perfect discrimination. As you see, all coefficients, all variables are strongly significant with the expected signs. So for example, the ratio of waste recycled to total waste is positive and strongly significant, meaning that the more the firm recycle waste, the higher its ESG performance. Or if the firm cares about biodiversity risk, the firm would be highly ESG performing, and vice versa. Then we found that we also calculated the classification matrix. So essentially we accounted for type 1 errors and type 2 errors and the rate of correctly classified firms. The rate for the environmental pillar of correctly classified firms is above 90%, 91.4%. Type 1 errors are a bit high, so it has to do with firms predicted to be 1 when they are 0, performing well while they are not, and vice versa, and the opposite for type 2 errors. Same applies for the social pillar. We run the model, strongly significant coefficients, signs as expected. Same for the governance pillar, strongly significant coefficients and expected signs, and high rate of correct classifications, 84% for the governance pillar and 95% for the social pillar. And then we confirm our results by running a logistic regressions. Why we transformed the z-scores into probabilities. I skipped these results. As you see, variables are almost all strongly significant and with the expected signs. Then we accounted for the accuracy of the statistical accuracy of the models, and indeed our models are accurate in terms of classifying firms. And then step 5, the very last step was to convert scores into ratings. It's too long to explain how we came up with Z-ESG rating matrix. The idea is that instead of using several rating classes, we comply with the market practices, and we came up with 10 rating classes from table A to single D, where table A means maximum ESG performance or compliance, and single D low, very low, or even no ESG performance. And we came up with a full Z-ESG rating matrix where the first 2 columns, for example, for the environmental pillar, is the Z-ESG scores for each rating class, and the second column is are the probabilities from the logistic regression. So, for example, if a firm has a Z-score of 4.5, because the Z-ESG score lies between 4.6 and 4.0, the firm will be assigned a single B rating with a probability of being ESG compliant of 84%. That's the idea. So any firm can be rated, any firm can be assigned a Z-ESG score and rated based on this Z-ESG rating matrix. What about the distribution of our firms across the rating classes? Our firms, the firms with a triple B rating, represent the most concentrated class across the matrix. There are 61 triple B firms, which represent almost 20%, 18.8% of the sample. A very poor number of single D companies, just 2. Most of the companies lie in the upper part of the rating matrix, 93%, while only 6.8% are positioned in the bottom part, in the bottom part of the Z-ESG rating matrix. We find a very high correlation between our Z-ESG rating and the Refinitiv ratings, above 80%. But while the Refinitiv, the former Refinitiv, the LZEG workspace, relies on almost 500 variables to come up with a ESG rating for a company. We only rely on 39 variables, the best of the best, reaching a very high correlation with a standard model used in practice, such as the LSG workspace. As you see, there is a high, the green dots are our ZESG, the black line, solid line is the Refinitiv rating. We did some robustness checks. We randomly select 5 different subsamples equal to 50% of our sample, and we run the regressions also on these 5 subsamples, and we could confirm our baseline results. We also applied a procedure that was developed by Lackenbrook in 1975 and also used by Professor Altman in 1977. We built 325 samples by removing one company at a time and running regressions on all of these 325 samples made of 324 firms, and we could also confirm our results. We also ran a robustness analysis of our dependent variable, the Y variable, by replacing the outcome from the survey with a standard indicator that is used in practice from RepRisk, the RepRisk index developed by this business intelligence company that is called RepRisk, that quantifies a company's reputational risk exposure to ESG issues based on the ESG incidents. This index ranges from 0, which means low ESG risk exposure, to 100, which stands for high ESG risk exposure. And so we assign firms to group 0, non-ESG compliant, when the RRE ranges from 50 to 100, and to group 1 when the RRE index ranges from 0 to 49. We re-estimated the models, and we find that our findings are very robust. So to conclude, our model has practical implications. Asset managers may want to utilize our model to identify new investment opportunities or to build their ESG compliant portfolios. Risk managers may want to exploit our metrics to build their own internal models to assess the ESG position of a firm. Credit risk managers may want to link the ESG score of a firm to its Z score to measure the impact of the firm's ESG compliance on its probability of default. Chief sustainability officers of companies may want to self-assess the level of ESG compliance of the firm they work for in order to design a better strategy to achieve higher ZESG scores. And also corporate boards may decide to include our metrics into their executive compensation plans by linking annual pays of top managers to their abilities to achieve higher ZESG scores. Okay, that was the paper. Thanks.
Thank you, Francesco. Thank you so much. Thank you so much. And we are late. Thank you, Altman. Can you start with your keynote lecture, please? You want to stay?
You have the clicker?
Oh, yes.
And can you get my PowerPoint?
Of course.
Buongiorno to all of you. Thank you all for coming today. First of all, it's a great pleasure and honor to be with you here in Rome on such a beautiful day. It's a little warm, but it's not so bad compared to what's going to be in New York next week. Thank you very much, Professor Marinano and Marconi University for inviting me. Thank you, Francesco, for the organization. I thought before I begin my discussion on the credit cycle and the growing importance of private debt in the global credit economies, I thought I'd give you a little summary of my relationship to Italy over the years. My first entrance into Italy was for a conference at the University of Bergamo in 1977. It was a conference organized by the rector, bringing an international group of researchers, academics, and some practitioners to discuss financial economic issues. And we gave birth to a new journal called the Journal of Banking and Finance, which evolved into one of the leading journals in academic financial literature. In the 1980s, I had the privilege of giving seminars for the Bank of Italy and for other practitioners. And I was introduced to the Centrale dei Bilanci. Some of you know this organization, was based in Torino, was owned by perhaps 50 of the largest Italian banks, and we performed some research with respect to building models for assessing the credit health of Italian companies. I guess some of you know that I built my first model in 1968. So we are close to 60 years now of celebrating this model. Maybe you'll invite me back in 2 years. We can celebrate 60 years together on this occasion. And of course, you heard from Professor Baldi the relationship between the Z-score model, which was a model to predict the financial health of companies, and using similar methodology to assess the ESG compliance of companies. I must say, as a commentary on our paper, that the importance of ESG is far more important in Europe than currently in the United States. It's a very controversial issue still, whether or not being ESG compliant adds value. How do investors assess this? But no question, it is a subject that is very important and will be in the future. So I began coming more frequently to Italy. I joined the scientific committee of the Centrale dei Bilanci. And then about in 2003, I was fired from my job. I was eliminated. Why? Because the Centrale Bilanci was purchased by a private equity firm, Bain & Company, some of you remember. And what happens when private equity buys companies, they cut costs. And so I was one of the costs that was cut. But still, it was a very important experience for me, and hopefully added value to the Centrale dei Bilanci's output. And then after many visits to Italy, giving lectures at various universities, at the Ministry of Economics occasionally, I was asked by the Borsa Italiana, could I build a model to make more transparent the credit quality of mini bond issuers in Italy. Many of you are familiar with the concept of mini bonds. Small and medium-sized companies issuing bonds directly to the public, mainly to financial institutions. And they were interested, the stock exchange, Borsa Italiana, was interested in promoting secondary trading of these bonds. And they felt that if we had a more recognizable, transparent, and accurate model of credit risk, it could help investors assess the risk and return trade-off to invest in mini bonds. And so I began thinking, how would we do this? I'm in New York. Borsa Italiana is in Milano. So it was difficult, but so I needed an emissary, someone who could help build these models. And I'd like to now introduce to you Professor Gabriele Sabato. He's here today and will be on the panel later on. And Gabriele was a visiting scholar at NYU, where I teach, and have been teaching now for 58 years. I haven't figured out a way to get another job, so I'm still there in New York. And I asked Gabriele to collaborate with me to build this financial risk model for Italian small and medium-sized firms. And he agreed. He was a senior risk analyst for Royal Bank of Scotland at the time. And so in his spare time and in my spare time, we built this model for the Borsa Italiana. And they liked it very much. And it became part of their important information for potential investors in mini bonds and in general. So Gabriele said, well, it works so well in Italy, why don't we build a model in other countries and make our research more practitioner-oriented on a global level? And so we formed a firm called Wiser Funding, based in London, and I was the principal shareholder along with other investors like Gabriele. And we started operation in 2018. What we did, however, to differentiate what we did for the Borsa Italiana and make it more global was to introduce the concept of artificial intelligence in terms of gathering information, non-financial, non-structured, and somehow introducing that into quantitative models to assess the default risk of companies. So we didn't call it artificial intelligence back then. We called it non-structured data that you could grasp by building a platform, APIs. You can grasp that information from various sources, such as social media, governance, company reports, legal proceedings, anything that was available, maybe tax records as well, combine it into models that would predict the health and perhaps more accurately than just financial data. Being an old-time analyst, I was not convinced that this kind of qualitative data, non-structured data, could add to the accuracy of our models. And I wanted very much to observe if it could be useful or not. It was not, at that time, the importance that is now attributed to AI. And I became convinced. The accuracy of our models increased by about 15% by adding non-structured variables to the traditional credit risk type models. And so my introduction to the Borsa Italiana's mini bond area gave birth to our work. And now we have over 70 models globally. We have models for Europe, for Africa, for India, for Asia, Eastern Europe, Scandinavia, US soon. It's ironic that the US is more difficult because of the lack of access to private firm data. But we are working with some partners there as well. I bring this up because we're going to talk now about credit in my discussion of the credit cycle and beyond Z-score, what have we learned over these 60 years. So let me present, first of all, a question for you to think about, and we will return at the end of my discussion to see what we think about that answer, which perhaps you first think about. So the first question to ask is, most people understand the business cycle: GDP growth, unemployment, tariffs, purchasing power, macroeconomic variables that measure the health of companies and sovereigns. But if I asked this group here today how you define the credit cycle, I might get as many answers as you are here today, 15 to 20 of you. And so one objective of this new research is to define the credit cycle and then ask the following question. So first, in terms of, I'm going to skip over the history of the Z-score model because we don't have time today, but I'll refer back to it. Okay. A very simple way to conceive of the credit cycle is a spectrum from benign to crisis. What do we mean by a benign credit cycle? Well, low interest rates, low default rates. If there are defaults, high recoveries to investors. And perhaps most important, a great deal of liquidity. It's relatively easy for companies to get loans, even if they are non-investment grade or low quality. However, things might get a little bit more difficult. The default rates may rise, the liquidity may drop, and we might have an average credit cycle. What do we mean by average? Well, whenever you deal with metrics, you need historic data. What is the average default rate of bank loans, of high-yield bonds, of investment-grade bonds? And fortunately, I've been living a long time, and I have lots of data on defaults. And some of you may know this, I love defaults. I love bankruptcies. Okay, well, if you have lots of defaults, you have lots of data to build models. And as a scientist, we need data. And if we are doing this over long periods of time, we can construct a distribution of outcomes, including an average. So, for example, the average default rate on a non-investment grade bond in the United States is about 3% per year. And in good years, you have 1% or 1.5% or almost no defaults. And in bad years, you have high defaults. And a crisis, you may have default rates of more than 10% of the outstanding population. So average. If things really get worse, things go to a stress level where the default rates are maybe twice the historic average. And then finally, we have a crisis. What is a crisis? Well, you know it when you see it. But primarily, it means that firms have very little opportunity to raise debt capital, even if they are relatively healthy, or if they are still non-investment grade or junk bonds. So this is a spectrum. So now here's my question for you to think about. So we have a simple definition of credit cycle: defaults, recoveries, spreads, liquidity. and we have the business cycle, recession, expansion, growth, unemployment, etc. Here's the question. Does the credit cycle lead the business cycle? Does the business cycle lead the credit cycle? Or are they basically coincident over time? Can we learn about what will happen in the economy from what is happening in the debt markets? Or vice versa, do we learn more from what happens in the business cycle and its impact on the credit situation? So that's the question for you. I'd like you to think about what you believe. Are they coincident? Or does one lead the other? For example, how many of you at this point, based on your rich personal experience, believe that the credit cycle, or credit markets in general, come first, move first before the business cycle? How many think the credit cycle leads the business cycle? Raise your hand. None of you. How many think the business cycle leads the credit cycle? Okay, 3 or 4. How about maybe they are coincident, they move together? A few, 2 hands here. And finally, how many don't think? Okay.
Professors do not think.
No. Well, I think that it depends on the source of the crisis. So it may be that one leads the other depending on the reason.
Oh, you mean so it's not all the time one leading the other?
All the time, the same story.
Okay, fair enough. So that's what we're going to explore together, and then we'll take the vote again at the end. A little bit of background on global debt. Some of you may know, I'm sure the Ministry of Economy is thinking about levels of debt. Not only Italian debt, but in general. And there are mainly 4 categories of debt in the global economy. Non-financial corporate debt. That's been the main focus of my research over the years. Government debt. That's, of course, the focus of your talk and others, especially if they are working for the federal government. Financial debt of banks, insurance companies, brokerage firms, so-called financial sector. And finally, household debt, mortgages, personal debt, credit cards, automobile loans, and the like. What is clear is that the amount of debt in the global system has increased dramatically in the last 30 years. Not only in amount, but as a percentage of GDP. So think about the global debt as you would consider for an individual firm, and you have a debt to equity ratio, or a percentage of debt as a percentage of GDP. You remember the European financial crisis of 2012, when countries like Greece, Spain, Italy, Ireland, Portugal had very high debt to GDP ratios. We are now very concerned with the United States. Not only how much debt we have, but how much interest we must pay every day. For example, this chart shows the dollar amount of interest payments over the last 7 or 8 years. Did you know that every day in the United States, we pay about $3 billion in interest to people who hold US government bonds? If you multiply by 365 days, you get about $1 trillion per year of interest payments. And it's growing for 2 reasons. The amount of debt is growing and interest rates are high. So the deficit and the issue of debt becomes much more important than it used to be when debt levels were lower and interest rates were lower. Keep that in mind when the US government comes to market with new debt. I'm sure you have the same situation over time for Italian government debt. You have to consider the amount, the interest rate, and the credit risk level of the country. Let's talk about leverage finance, which is the focus of my research for many years. There are three types of what we call leverage finance. These are, in the corporate sector, debt issued by non-investment grade companies, below BBB. High yield bonds. This is a passion of mine for many years. I was the first academic who was exposed, if you will, to the so-called junk bond phenomena, starting in the late 1970s. Drexel Burnham, Michael Milken, and I was asked by Morgan Stanley to evaluate for them whether they should get involved in this new market. Obviously, this market has grown a lot. This is the growth rate of high yield bonds, but interestingly, that growth has leveled off at about $1.5, $1.6 trillion. Why has it leveled off? Why isn't it still growing when corporate debt is growing? We will come back to that question in a moment. Second, leverage loans, or bank loans to non-investment grade companies. Another name for that is BSL, bank syndicated loans. Loans made by banks, many times sold off in the form of CLOs, structured financial instruments, but these are regulated banks making loans to low-quality companies, leverage finance. And finally, the so-called direct lending or private debt market. I estimate that market is about $2.5 trillion in the US today. Some other estimates coming from investment banks are about 1.82 trillion. But clearly, it's the largest source of non-investment grade debt and growing dramatically. So let's spend a little time on discussing private debt. By the way, this is not only an issue of concern for the United States. 2 weeks ago, maybe 3 weeks ago, I forget, I've been traveling first in Portugal and here in Italy for about 2.5 weeks now. There was an article in the Financial Times. Some of you may have seen it. The EU Central Bank is very concerned with stress testing the impact of the growth of private credit on the banking system. Why is that an issue? These are non-banks making loans. Well, first of all, non-banks are usually not regulated like banks. Second, the growth rate in this area is exponential, very much correlated with private equity. So the growth of private equity is synonymous with the growth of private credit. I know many companies now, many groups of companies, don't even go to banks anymore. In the United States, we have some data here to show you that only about 20% of corporate debt is coming from banks. 80% from various other sources, hedge funds, insurance companies, high-yield bonds, and the like. So, why is the European Central Bank interested in stress testing the growth of private credit? I will now show you why. First of all, here is the growth of private credit in the United States. From about $1.2 trillion 6 years ago to about $2.5 trillion today. By the way, that's my estimate, so you might read from various other sources that it's maybe 2 trillion or 1.8 trillion, but it's more than the other forms of leverage finance. The main issuers of this debt are called BDCs, Business Development Corporations. What is a BDC? It's a non-bank, it's an institution that gets its money from various non-bank sources, but also from banks. Here is an example, it's a bit complicated, of the BDC structure. So, you have what's called a master fund. That's the BDC, the Business Development Corporation. They get their money from either levered or unlevered feeder funds. And those feeder funds are financed by insurance companies, pension funds, and the stock market. So there are over 100 BDCs listed on the New York Stock Exchange. They raise money from the equity markets and pay a very substantial dividend based on their profits over time, about 8 to 10% dividends. Now, the average company on the New York Stock Exchange probably has 1.5 to 2% dividend payout ratio, dividends as a percentage of price. This sector is 4 times more or more. So you can understand its attraction, as long as they are making substantial profits. These feeder funds are deriving their funds from institutions like insurance companies, pension funds, private investors. I know some family offices, for example, who have as part of their investment portfolio a substantial either partnership or direct investment with a BDC, a master fund. I do some work for one of the largest of these BDCs, a firm called Golub Capital. Some of you may know the name. Golub Capital has about $60 billion of assets under management. 10 billion are based on publicly owned BDCs. 50 billion are private. So 10% is regulated. Sorry, 10 billion is regulated. 50 billion is not regulated by the SEC, or the equivalent you call CONSOB. So, why is this also important to banks? Well, if you notice on the schematic, Bank 1 and Bank 2 are also making either short-term or long-term loans to the BDCs. And now we have institutions like BlackRock, the largest financial institution in the world, buying BDCs and becoming a private debt issuer. And they're not alone. So we have 4 or 5 private debt issuers that have hundreds of billions of dollars in private debt outstanding. This shows you the growth. But keep in mind that they are lending money mainly to companies owned by private equity firms. So, for example, where is that? I have it somewhere. Okay, I can't find it. I thought I had it here, but let me tell you, in the United States, 87% of companies are privately owned, 87%. And of that, the majority are owned by private equity firms. I don't know what the relationship, anybody know what the relationship here in Italy is? How much do private equity firms own? How many firms? What percentage of the private, of let's say greater than $100 million in revenue companies? What percentage are owned by private equity? But small compared to the US, but growing. At least a lot of the people I talk to say, oh, my son is working now for a private equity firm. Why? Pretty obvious. It's a way to perhaps get high returns in terms of salaries and the like. Okay, a little bit of generalization that bank borrowing has increased substantially by these BDCs. So the banks are exposed to the BDC market. How much? I don't know about Italy. I don't know about the UK, Scandinavia, but increasingly in the US, I would guess about $500 billion is loaned from banks to non-banks. They in turn around and make loans to non-investment grade companies. So there's this symbiotic relationship. Right now, I believe private equity is under some stress. You may not think this, but here is the reason why private equity is having problems today. Private equity are owned by limited partners. Limited partners are pension funds, insurance companies, high wealth individuals, family offices. They usually make make investments in BDCs, and they want their money back in 3 to 5 years. That's generally the horizon, which means that the private equity firm must sell their portfolio companies in order to return money to their limited partners. In today's market, with high interest rates and somewhat of a challenged economy, the sale of private equity-owned portfolios is having problems, meaning that the private equity firms cannot churn their sales into dollars to repay their investors in that 3 to 5 year period. That means that they will not have the ability to make new loans to new firms to put into their portfolio because their money is tied up. So, if private equity has problems, perhaps private debt will have problems. Finally, why is private debt? I have some metrics on default rates to share with you, and then we'll go to the question I mentioned. These are the variables I look at when I'm assessing where we are in the credit cycle. Default rates, recovery rates, required rates of return by investors in leveraged finance companies, which is very interesting what's happening today. Also, liquidity, the ability of non-investment grade companies to issue new debt. Now, default rates, we will look at in a moment. But I'd like to concentrate on that third category, investor required rates of return to invest in non-investment grade companies. Leveraged finance, high yield bonds, leveraged loans, private debt, have about, on average, a 5% risk premium over the government rate. So the US, I'm not even sure what the 10-year Treasury rate is today. Somebody perhaps can tell me, but it was around 4% or so when I started traveling. A 5% premium means that you should require, in average times, about a 9% return to invest in non-investment grade companies, 4 plus 5. Today's market, the risk premium on non-investment grade companies is between 3 and 4%. Why is it so low? Are things so benign? Is there less risk today than history? Or is there a structural change in the leveraged finance market? So this was a question I was looking at. In fact, this chart shows you the spread or risk premium on high yield bonds. The historic rate is around 5% spread. Notice that back in 2008, 2009, during the crisis, it was over 20%. Nothing could move in the credit markets. Today, or recently, under 4%. It rose quite a bit, but still less than the historic average, which trumps tariff situation, which is another subject we may want to discuss. Why is it so low today relative to history? I have three potential reasons, and I'd like you to think about this. One, well, maybe even though it's below average, since interest rates are higher today than they've been in prior years, recent prior years, the absolute return is still quite high. So a 4% premium over a 4% government rate means still 8% return. So investors are fat and happy, even though it's below the historic average spread. Some of that I think is true. Second, maybe my models are not correct in terms of expected default rates. That's another issue. Third, and I think most important, competition with private credit. If you are a company and you want to issue debt, and your investment banker comes to you and says, okay, I can issue your bonds in the high yield bond market. Historically, you have to pay something like a 5% risk premium if you are, say, a B-rated company. But today, we have competition from private credit. So we need to make your debt more attractive to the companies to choose high yield bonds rather than private credit. So we're going to lower the spread. I think this is the main reason why spreads are below the historic average in today's market. It's hard to prove that, but I think that's the main reason. So finally, let's get to the question I proposed to you earlier. And before you vote again, let me show you some data. I'm going to skip a lot of data. Okay, so this is a chart that may interest you. It shows you the yellow bars represent recessions in the United States. So if you go back to the 1970s, we've had 7 recessions of various duration since the 1970s. So we are very fortunate in the US to have many recessions. I say that kind of facetiously, but what I mean is that we can now measure the relationship between recessions and credit markets. And the credit markets can be articulated by default rates. So the solid line represents default rates in the market. And if you notice, let me show you here, if you go back to, say, the last 4 recessions, when the markets were large enough to make a difference, you notice, say, 1990, 91, 92, default rates went from below to above the historic average, and then peaked at around 10% for 2 years during the recession. In the recession of 01-02, default rates went from below the historic average to above, and then peaked again during the recession. In the great financial crisis, default rates went from very low in 05 to way above the historic average in 06, 07, and in 08, 09 peaked at about 12%. And then finally, you have COVID. Very short recession, but the default rates went from below to above, and then peaked at around 6%. It would have been much higher, but like your country, the US took longer to support companies with subsidized loans, with the Fed lowering interest rates, and so default rates did not rise to the 10 to 12% level that they would have happened if there wasn't fiscal and monetary policy. Bottom line, I believe default rates precede, or movement of default rates precede economic recessions. I can't always prove this. In fact, most economists would probably vote the way you did, that the business cycle leads the credit cycle. I find the opposite. So it's, it's relevant. The question is, what about today? Well, here's my final point. I've got a dilemma. Because default rates on high yield bonds, I have data, is very low today, maybe 1.5%. But the default rate on bank loans is almost 6%. Here's the bank loan data. Why are bank loans, non-performing loans, default rates so high today, and high yield bonds, another form of leveraged finance, so low today? Okay. Very simple. High yield bond interest rates are fixed. 7 to 10 years, fixed rate. Bank loans are floating rate. They move with inflation. They move with interest rates. The interest rates move with Federal Reserve policy and inflation. So, default rates last year and so far this year are much higher on bank loans than on high yield bonds. So here's my dilemma. Normally I'm looking at high yield bond default rates, and the correlation over time between high yield bonds and leveraged loans is about 0.9. But not in 2024, and not so far in 2025, when the two default rates are divergent dramatically. And so, my conclusion is that if I look at the bank syndicated loan market, I'm predicting a recession in the United States by the end of this year, or in the beginning of next year. If I'm looking at high yield bonds, it looks much more benign. And so, for the first time, I have a dilemma as to which market to look at in order to forecast a recession or not. I leave you with that now because I'm trying to solve my dilemma. And with that, I would, sorry, I don't know if I took too much time.
No.
Mille grazie, thank you for your patience.
Thank you. Thank you so much, really. Now we... Allora, Roberto e Stefano.
Want to sit here or I'll move over?
Okay. Good morning. Thank you very much. It's a pleasure and honor to stay in front of this such standing speaker. I work for Unicredit in the credit intelligence function. My role is to support our commercial colleagues in the lending phase and pricing. We try to make a journey. I try to simplify how the environment, the rules of the regulators and the market are going to affect through the years and up to now the activity of the commercial banks and the financial institution. I'm very happy to see that before the professor Baldi and Altman, they touch real critical point that we try to face in our lending activity. So just the background, we know that from the beginning, the regulator tried to support the market, providing a framework. We start from Basel I, now we are Basel IV, and upcoming the ESG rules. And Unicredit try, growing as a systemic bank to apply an approach, risk-adjusted pricing approach. I built up in 2010, up to now is spread in all the legal entity across Europe. It's an approach that is going to follow the principle of the framework of the regulation and also following the credit cycle and the market. So, in a very short point, the risk-adjusted framework, which is at the beginning, the banks have just simple tables of pricing by product, medium term, side asset, short term, and that's it. Whatever is the customer, this is the price. The regulation, looking at the crisis, the last one that affect also my business was Lehman, that changed a lot the market, we know. The big falling angel, too big to fail, they said at that time. So we try to implement a rule to evaluate the customer that we have in front, to push the lending and support the system, and the risk-adjusted pricing in this scheme just provide that looking at the risk level of the customer, we can try to rely a pricing adjusted to that. When I say the risk level of the customer, we know that the regulation provides to us the need to develop three main factors, the probability of default, the rating that we heard before of the rating class of the customer from example AAA to CCC, the default. Then we have that is crucial, maybe there is still, from my perspective, not a very deep culture on loss given default, which is the loss that the bank has in front of the default of the loan for the collateral that behind there. And that is a crucial point that we are going to touch, talking about the ESG parameters. And then there is also the exposure, how we are exposure with the customer, companies and firms. This is a crucial point that we have to manage. So this scheme start to say, okay, we can try not to have the same price for each customer and loan, but try to differentiate in order to provide the right pricing to the right customer relationship. I want to touch a point that is related to the risk, that for sure is anticipated by the Z-score model, but also in the internal model regulation. We know that the rating class is something that we apply to a customer, to a company, but is a standalone risk. But it depends on the age of the customer, in which phase of the spectrum of the credit cycle that the professor said before, We are young customer and company, maybe we are not a very big rating, so we are going to grow and to be very strong customer. So the approach, very simple, I try to simplify here, that is applied to each transaction that we apply in the group. It's built up on the economic value added metric, we know everyone, it's very easy, where there are internal factor, external market factor. So for each loan, our business, they have to look at the base rate, Euribor and IRS, that is currently directly affected by the market, as we said before. And If you look at companies, maybe they look at some base rate. If you look at private, like mortgages, they look at IFRS, sorry, because it's more stable. The cost of funding, so the cost of the money for the bank, and it depends which bank we are talking about and where it's placed as a country. And then we are looking at the metrics of the absorbed capital, so the risk-adjusted brick that you see there, the red, that is related to expected loss and cost of capital absorption for each transaction. That is close to, yes, sorry, is close to the idiosyncratic risk of the customer, the risk of the loan, and also the tenor of the loan. For the tenor, I have a picture later that is going to show you what we are doing close to what Professor Altman said about the credit cycle. Because this approach is matched to maturity, means that we are going to evaluate this minimum cost up to the red brick for each transaction that try to estimate the cost of transaction now for all the entire maturity. On top of which, our commercial colleagues apply a markup or markdown. It depends on the commercial strategy. I try to simplify what is a complex banks in lending, but this is a simple scheme that everybody apply from institutions, small firms and private. And then we arrive to the NII. Just a picture. We do not look just at the transaction because we work with the customer, with the company. Strategy, there is a cost, but we have also additional revenues. The level red there, not only to the transaction, but working with, okay? So this is the real scheme that we use, and we start to look at that. The red box is related to regulatory figures. So up to now, we have to follow, in compliance with the framework of Basel IV, Basel III, IFRS 9 that we see later, how they're going to affect. We have to estimate this cost. ESG, because we are here to talk about. We are in a bridge phase. So up to the moment that we can have a differentiated absorbed capital for ESG parameters, we are trying to introduce some pillars, some drivers, as Professor Baldi said, So covenant related to the three main in order to boost the culture of ESG, also in the relationship with the customer. Here, these pictures, for me, I like very much because in 2010, also hearing some speech of these people and other professors, backward-looking and forward-looking. Why I said that? We have seen before that Professor Holton said that there is the credit cycle that affect and is linked to the default rate. Up to now, we know that for regulatory rules, expected loss, so rating, LGD, is an internal estimation based on 1 year figures. What does it mean? That if we look at a company, medium company, you have 3 drivers in the rating, the financial, the behavioral, and also the relationship score. The financial, if we are lucky, are 1 year ago, and we know that a lot of things changed. So we are not captured up to now what is going to be today and tomorrow. Course of the other 2 drivers, but it's not enough for our perspective, because looking also at the principle IFRS 9, we have to look, for instance, when I provide a 5 years loan, what's going to be sheet debt financing for 5 years. My default rate close to the credit cycle can change. Also my absorbed capital, positively or negatively. So I put there just a picture of a RIBOR that is close to what we have in mind in the credit cycle, So the default rate before and after are going to change despite the market condition. That's why we apply in the picture that we are here in the red brick a premium that is a year approach in order to, let me say, ensure to hedge the credit risk evolution in the pricing that we do now. So that's why we arrive here. So up to the right, you see the break-even, that is the sum of the base rate, the cost of funding, absorbed capital, and credit risk. But how is estimated the expected loss and cost of capital? Watching the default rate, try to learn from the credit cycle, and with our credit risk colleagues estimate the curve, multi-year transition metrics, that try to predict what's going on. When I saw the spectrum of the Professor Alton, that is the point. Because in some period we are in a transition metric, so a curve of default rate through the years that could be not so steep, but in a recession you may have a jump of default rate. With this estimation of credit risk, we can apply a risk-adjusted spread that is close to match to maturity pricing. On top of which we have this green brick that is the markup. Our commercial colleagues, for instance, I have 100 basis point, that is the break-even sum of Euribor, cost of funding, risk-adjusted. How much I want to earn? The markup is based on the commercial strategy of the bank, cost of equity, blah, 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 but now we are applying this markup also close to the ESG market. Because, as I said, we are in a bridge phase, so we cannot have in our portfolio a lower absorbed capital in somehow for ESG principle, but we are going to anticipate changing the markup for ESG loan, both for company and individuals. We are going to see later some example. So, for instance, think about private financing, the mortgages. Now the strategy is to have, and you can see in all the market of financing in Italy and I guess in the other country, that the pricing for mortgage loan with the house with a very good energy class, the price is very low. This is a bridge because, as I said before, close to the collateral there is the driver of loss given default. So if I'm going to put in my portfolio mortgages related to high class collateral, if there is a jump to default, my recovery rate is very good because I'm going to the market with a very high quality environment. So the bridge is also in the markup, so in the commercial pricing, it's also to support this culture path, this is my view, to the customer. Because when I saw in the paper before, the variable of ESG, some companies are boosting this part. Linking to as a covenant in the financing, they start to understand that they can have lower pricing. Commercial pricing, lending pricing is facilitated with these drivers, with this covenant. This is the bridge that I'm telling to you. And so, as I said before, this multi-year approach related to this driver, as you see, just a very easy scheme, that if I predict with my risk colleagues the evolution of the credit quality, I can set a pricing, commercial pricing, that offset my revenues through the tenor of the transaction. So stable profitability in my portfolio. So I have a good differentiation in credit quality ex ante, hedging the cost of the transaction, and also somehow try to have a good performance in my portfolio, in my stock. ESG. So for sure, through the main three channel, commercial channel, corporate, medium and small enterprises, and private, we already have, it is not advertised, just to put you a link to go through also to the variables that we use up to now for the transaction. The first two, Futuro Sostenibile and Futuro Sostenibile Plus, are transactions for medium long-term facility to companies, so medium and small, that link to specific variables. We start to price with a cheaper price despite the normal financing. It's crucial that it's not at the beginning. So in the transaction here, we link the pricing to covenant, ESG, some variables that are very clear, but we have a checkpoint after. years. So they have not just to say, okay, I have this governance, this green collateral, whatever, but they have to persist on this path also through the duration of the transaction. This is really good because they link that is, they know that everything is good. It's going to affect, as I said, LGD, the rating of the class, and also the governance. Okay, so the governance for me is also important in terms of stability of our companies, because somehow for default rate and jump to default they change a lot, no? And for, if you remember, I said the rating on average is based on 3 variables. Financing, that for big companies is the main driver. When we move down to small company, financing has a weight in the rating final score, but there is the behavior and also the government stuff that are more important in the final score. Here, the governance is going to affect this part, because sometimes we do not think about that, but the stability of the governance of the company is crucial in the relationship with the bank. Because if I'm going to give you 7 years financing, medium term, unsecured or secured, and I know that you're going to change 2 times in the last years the governance of the company, sorry, but I'm not so confident, okay? So, again, here the green brick, for me here is the normal markup that each bank apply to the break-even cost, so to reward all the cost of the bank. Here for ESG, we are in the bridge phase. We anticipate as a discount to the pricing what is going to be related to the variable ESG. What we have seen with the professor before, that is supporting these papers, our risk colleagues, to develop the model, is to link the cost of risk and capital to the credit cycle, to look at forward-looking approach to be matched to maturity in order to prevent the loss and to hedge, to look at non-performing loans. We do not like the default somehow. I may say that. So I'm here. This is sorry, I want to be cheerful and funny with the picture there, but this is the evolution of the pricing in the banks. No, Basel I, as you see, the first line is the same price for different credit risk customer. And you can see that the red dot is the cost of capital. So you see that there is absorption differentiated by good customer C1, not good customer C6. Then we move through Basel II, the internal rating model, Basel anticipating the portfolio. And then you see that we start to have low. And there is 2 drivers that are going to affect the pricing. The capital light approach, so the collateralization, the government collateral that we and also ESG driver that is going to affect the pricing, support the social company that are moving in the background of the regions and in Italy, and also the drivers related ESG to the collateral that is crucial for the future absorbed capital. Okay, thank you very much.
L'ha messo sul desktop. Infatti, sto cercando di. Ecco, come in. Fast like our trains. Ok. No, ma
Stefano, ti presenti da solo così. Comunque, Stefano Pierini, grazie.
Yes. Well, Thank you very much. It's a true honor being with you today. I think I could dream of a lifetime being with Professor Altman. So, and probably using his words, I think I might be considered as a practitioner, okay? Because I'm one of the guys which raise money from the market. And so today I want to show you which is the use of the ESG philosophy that Ferrovie dello Stato Italiano made since 2017. This is taken almost from our investor's presentation, so some pages can be skipped, but just to give you an idea how important is the size of the company. We're talking about a group that has been growing, namely from the moment when we started our high-speed trains, which has been a game changer for us. And the numbers of 2024 telling us that the revenues are more than 16 billion. With a huge amount of equities, it's something that makes a lot of bondholders happy, because if you look at the capital invested capital, which is 555 billions, then we have an equity of 41. So we don't pay too much dividends, and probably the Minister of Treasury might be asking for more, but obviously the railway business is a peculiar business. Again, I'm the one which is separating you from the coffee break, so as it should be in 5 minutes, I will try to do it no more than 10, I promised you. But questions during the coffee. Here you can see which are the thoughts why we are today perceived like the Republic of Italy. Happy to say that if you look at the standalone credit profile, the company has one notch higher than the general one. So it's one of the cases where the robustness of the business and the financial management then obviously is capped by some elements which are part of the methodology. But let me go into the pie chart. So government-related entity, it is true, and you will see it in a while. Strong financial reliability. We have the whole package of what the professor tells at the university. You should have loans, you should have bonds, you should have a credit facility. So we never miss the whole package of instruments. And as a matter of fact, we are the most important investor in the country. This is to give you again some numbers. And you see from 2023 there's been a spike up. So can I address you a question like Mr. Altman did? What is the reason why there's a spike up in 2023 for those who follow the important things happening in this country? It's Next Generation EU. So Next Generation EU, so in Ferrovie, the most important investors, we can rely on a huge amount of, this is the numbers of PNRR. We are expected to receive by the project that we have brought to the attention of EU and the Italian government close to 28 billion of investment. And as you can see from here, we have completed a significant amount of the, up to now, of the project, that we are completely in line with expectations, and 12 billion has already been invested. If you then go through the, you skip the single items and ask yourself, high-speed infrastructure, 8.5 billion, railway infrastructure, fleet renewal, interventions in tourism. Well, you can either decide if it's E, is S, let's set aside the G for a moment, but we have our DNA modified because of the business we are in. So we are definitely ESG 100%. It's not over. That's what you can find in the pages of our brand new business plan. So we're talking about the next 5 years, 100 billions of investments. Not all from debt. So Professor Altman, we shouldn't be too worried. It comes from partially and significantly from Maria, which is an incredible source of money for us. But then this gives and tells you a lot about the virtuous cycle that an ESG approach might have. So I don't want to bother you on all these things, but happy to talk later with you. So this is something quite simple. This is from Statista. You might be aware it's it's a platform. So the two stars you see on the bottom is the railway business. So whatever transport you think of, we are in the very, very, very lower part. So we are the least polluting business. This is simple. And then if we add that we are also, like some others of this one, actors for public transport, obviously, think about how many cars you leave in your garage when you take a train. This is from Financial Times. They published half of 2024. A very interesting article, which the title is "All Green Bonds Are for Trains." So that's final word for that. But this tells you a lot, because you can see here, countries have raised more than 500 billion by selling sustainable sovereign bonds, and that's where they go. So transportation is taking 60%, and probably it goes back to end of 2023 and published 2024, but probably today is more. If you go in France, if you go in Germany, in Italy, Maria has made an enormous work, and I think the latest transaction on green bonds of the Ministry of Treasury are for our infrastructure on 30 to 40%, I'm right? So it's an ideal place where to put money, and to also satisfy the add-on pricing from Eurocredit is the nicest where to put money without not that risk. That's what we did. We have a huge program, 12 billion, which is traditional for those who are active on the debt capital markets, general corporate purposes, but we added 3 or 4 lines when we clearly address and we commit ourselves in using the money for investments. You can hardly see in any issuer, because general corporate, it gives you a broader spectrum in order to raise funds, but we did it on purpose. And for those who are interested in, there's a part of our investor relation site where you can go through our green bond framework, where we go into very detailed description where the money goes. And I think this is one of the nicest achievements that the ESG financing world has. You have continuously to witness where the money is going and proving that you are doing exactly what you've stated. So as much as the investors and the whole world, whether rating agencies, second-party opinion providers, whatever they are, this makes ESG a sustainable finance world. We started in 2017. And I do remember I was in Paris and London, and I have evidence, at the time I was showing evidence, that 94% of our trains are recyclable, which is something few people know. But that's absolutely true. And moving towards electric trains, we were already, working a lot with electric trains, but it gives you the possibility of saving an enormous amount of CO2. So that's what the EU taxonomy then and followingly take as a main tool. And what is interesting here is that we didn't talk since the very beginning only of green bond investors, but we were lucky and happy to solicit the interest coming from all the investors' world. What I think is worthy to say is that maybe it's the business we are in, maybe it's the size we are in, but supranationals are very much interested in making this word a nicer word, and where environment might be something pretty good for our children. And if you look at 2020, we succeeded in doing 3 different things, already having our bonds in the portfolio. So EIB made the first climate action financing in Europe with us. So we, I don't know if you're familiar with the approach of the credits on EIB, but EIB looks for a while on the credit and then have engineers talking to you for hours and hours about the project, knowing everything in detail. So it was a real proof of how powerful is the work that we are doing, that we are continuously doing in Ferrovia. Eurofima is another supranational body. This is lesser known counterparty, but this is a wonderful body which dates back to 1956. It's very interesting if you look at the Articles of Association. It's written, this is for Europe. It's owned by the countries, created for the brand new rolling stock fleet in Europe. So it's very forward looking as a thinking. And even in that case, we were the first in placing, these are private placements actually, and Eurofima today is the greatest issuer of bonds on trains because they are collecting money for all the Europeans, raising funds and giving money to all the European railways. Last but not least, we move the same approach, talking about trains, talking about maintenance, talking about infrastructure, in the world of green loans. It's not private debt, this is banking debt, and I think that UniCredit has part of these loans with us, and it proves how much, even though, probably something better can be done from a regulatory standpoint. So I think it's probably, if we want to have a further development of this word, I think regulatory item should be a little bit more focusing on ESG word. 2021, first coupon, first corporate bond, green bond, private, underwritten by EIB. So we've been the first. Good to know Italians sometimes can be first in raising money. So we are going onward on that. A couple of things. This graph gives you, how the repayment is foreseen in the next year. But as you see, the green part of the chart is growing. So today I was trying to make some calculation about is there still a greenium, is there an interest between our old transaction and the new one, but unfortunately, as a matter of fact, from 2017 we were only green, so you can have a completely green curve, and so the greenium, as far as I can see, is something that is either negligible or is hard to prove. But we are sure that 3 years from now we'll be pretty close to 90% of our financing being completely green. For two couple of reasons. Because as you've seen, we are going through a massive amount of investments. So all of them are perfectly eligible either for EU taxonomy or whatever will be the evolution. We decided at the very beginning that we don't want to be just compliant EU taxonomy. We want to show the investors that I buy brand new electric train, replacing old electric trains, and so every time I show how much I can save further in this direction. The latest train will be 98% recyclable. It's weird, but it happened, and probably it is also worthy to mention, thinking about credit. The good credit can, be of help to an entire economic system. That once we have, as you've seen, the possibility of investing 12 billion and hopefully the whole 28 that we are supposing to have, it gives an incredible boost to your supply chain. I've seen companies like Alstom, like Hitachi, like Siemens changing completely their way of building trains once you put an order from a company like ours, which can be from Deutsche Bahn or SNCF, for billions of brand new trains. So they change their approach, they change the quality and the ESG profile of their supply chain. So this is something that we are experiencing. If you want, there's an amazing piece of documents made in our Bilancio Sostenibile, which is worthy to explore. But again, this is showing that our ESG approach is there to last. Sorry, I was a little bit tired yesterday. I wrote June 24, but it's June 25. So this is the latest transaction that we've been through. This is the case study which comes from the banks. I don't want to bother you, but it was a very good transaction. I do not use the word successful. I don't like it. But this the 10th green bond that we have been issued since 2017. So again, next time I would be happy to show Professor Altman the whole green curve, hopefully even for a longest maturity than the traditional one that corporates like ours have the possibility to achieve. Then, happy to say that we are the greatest issuer. I don't know if in Roma they say, the more debt you have, the longer your life. So I really hope that this proves it is right. But as a matter of fact, we are the greatest issuer in Italy as a corporate of green bonds. So you might think about Enel, and you might did it right. You might think about Terna. You might think about A2A, which is making an incredible work. So, but it's all utility business, and it explains why they have a specific interest in that area. Less intuitive from FS. Just a brief mention on our green bond framework. We work a lot on that. All our projects are perfectly aligned, and we are very much limited because of our commitment to the whole investment process and the whole investment world. The look-back period, some others can go up to 4 or 5 years back, so you can redefine investments which probably you funded differently. And we don't go too onward, so look forwards just for 2 years. We started with I really hope you have all using Trenitalia, not only Italo. So Trenitalia electric passenger train. Then we moved to our freight business. mc2 is the company which is, like the word in Italian is saying, to the transportation of freight and all the logistic business. And partly stealing the incredible work that Maria is doing for us. For the first time, we did in 2022, financing also the infrastructure. Why I'm telling you? Because the infrastructure, what is perfectly EU taxonomy aligned, and this will be part of the presentation of Maria, it is not envisaged as of today that we go as a FES raising fund on infrastructure. This is a part of a different, structure. We fund mainly trains, all the maintenance. In this specific case, this has been possible because we raise funds for the high speed. High speed is considered as a separate a sub-industry of the infrastructure, and so we could leverage with our name on the market. We think that, as we said, we satisfy all the requirements of the ESG world, and namely the E. But we also believe that you can insert some other KPIs in order to prove the whole financial community that you are a real counterparty even on the social side. So this is the only thing that we did on sustainability. There's another, for those who are experienced, the sustainability link word is something different. So you don't need to be just compliant with E or L, purely DS. So we made a mix of CapEx aligned. We have nowadays close to 89% of our investment which are perfectly aligned. The energy intensity, this is a ratio of that we use, and the increase in the percentage of female employees, which is partly social and I guess partly governance. And if I'm not wrong, this is the second or third a revolving credit syndicated facility available as a size for Italian corporates, which has an enormous sense because it proves the rating agencies that we have a safe pillow where we can rest our head if ever the market goes into recession. So you've seen, which is the expiry in the next 3 years. We don't have any year more than 1.5, 1.6 billion euro to raise on the market, even for repaying our bonds. And so happy to say that we have completed with a different product also the word of the revolving facility. This is a committed facility, so the banks are committed for 3 years with us in this respect. As I said, I didn't respect the 10 minutes, definitely. That's what I was saying. You find it in our bilancio sostenibile. This is where we are today. If you had the chance to look at it a couple of years ago, we were a little bit lower, so it's an ongoing work. But you have turnover, OPEX, and CAPEX. So the number I was saying before, 89%, actually is 88.3%. And it proves to the whole world that this is the right business. Let's think, and I didn't see too much, probably because of the size of same kind of work made from municipal transportation companies, things which are similar, but there's enormous possibility for this word. Think about the word of the subways in Italy. They are perfectly eligible for that. And I really hope that, this experience of ours can be shared and taken by other entity. Thank you.
Sì, facciamo una piccola inversione perché, perché abbiamo sforato coi tempi e io più o meno vedendo l'orario ho detto adesso tocca a me, invece no. Vabbè. Ok. Allora, vedete il titolo è un po' il ruolo dei green bond, delle emissioni di green... Ah, sorry, it is in English. Yeah. The green bond issuance within the policy of management of Italian public debt, and also the contribution that this activity has given to the positive moment that we are living now. Because, we are living in a world with several factors of crisis and instability, and on the contrary, the Italian government bonds is living a good period, and this even in a context with a level of public debt that unfortunately has remained quite high, and with some also difficulty in reducing the debt to GDP ratio. But it is quite evident the good performance of the spread versus bonds. And this, in my opinion, is due to a couple of elements. First of all, the stability, political stability in such a difficult and different context overall the world, with also a clear linkage to the EU, differently from some moment in the past. You can see in 2018 we lived quite a troubled moment just because an attitude that was not so favorable to work together with the European Union. Now, on the contrary, we are around 100 basis points. For several days in the past weeks, we have been below. 2 days ago, we are around 100. But, in my opinion, there is also another factor that has contributed to this good perception from the markets. So the activity of issuing green BTP has shown that there are positive elements regarding Italy. First of all, the evidence that this activity has given to the relevant amount of expenditure with the beneficial effect on the environment that are in the state budget. Even before considering the goals that in any case Italy subscribed in the past together the EU and also in the Paris event. So there is also this activity implies an engagement in ensuring a punctual of monitoring, of reporting on the use of proceeds collected to the issuance. And also the clarity and the increasing degree of detail that in every annual report is given, and in general the transparency in the communication, because apart the annual report, there have been several occasions in conferences and meeting with investors, some press release to explain how this activity is evolving. This level of transparency has been a lot appreciated. And moreover, this is quite a challenging activity, because there is an evolving regulation that is more and more demanding. Also, investors are demanding more details, analysis, and so on. And every year in the annual report, there is an improvement in the quality of impact assessing, and we have used the ICMA principle framework, but the Treasury is trying to approach as much as possible also to the taxonomy, the EU taxonomy. That is not so obvious. We will see why. So, in particular, it is challenging for a sovereign, and not only for Italy, because, first of all, the taxonomy has been written and conceived for corporates, for companies, and this is create some problems to adapt these general rules to the specificity of a sovereign. Sorry. Nevertheless, this activity of issuing green bond started at the beginning of March 21, after the publication 1 week before of the framework, that is one of the requested necessary requirement to start with this activity. And for allowing it, it was necessary before to have a legislative scheme that permitted to go ahead, because we must ask a lot of detail and information from other administration, other ministries in particular, and it was unavoidable to have support from the law. And this occurred in occasion of the budget law of the 2020. Unfortunately, it occurred in the meanwhile, the pandemic, and some month was needed to the issue of the constitution, the decree for create the interministerial committee, in which all the ministries that are managing a chapter of the budgets with expenditure eligible for this activity collaborate to provide the necessary information. What are in particular the problem for a sovereign? A sovereign has a variety of expenditure, quite heterogeneous in the state budget, and we need, moreover, and not always, this expenditure correspond to investment and to project, to specific project. There are also operational expenditure, like, just to give you an example, the maintenance of natural parks, or also the maintenance in terms of the railways structure, in particular this year, as Stefano mentioned before, in the portfolio of eligible expenditure, the sector of transport is one of the most relevant, until now the most important one. But also the ordinary maintenance of the infrastructure is something that is operational expenditure, not a capex. And or other example, the activity of Vigili del Fuoco against the fires and so on, or institute of research that are addressing their activity in the research on sustainable transition, like ENEA or ISPRA, is something that needed to be financed independently by single projects. And this is something that the taxonomy doesn't cover so well. And another difficulty is that, as I mentioned, there is a multiplicity of stakeholders that have to be engaged in doing work that is quite different from the previous one that they are used to make, and it is quite a long story, but we will see also quite successful, even in a context in which the start was not so simple. And okay. And another very important point is the care to avoid the double counting. This is because there are certain expenditure or initiatives that have, even if in a minor measure, until a certain moment, of resources channeled directly from specific, for example, the proceeds of the sale of CO2 share are financing some specific expenditure that are present in the state budget, but being this direct channel cannot be considered. And even more important, when the start of the RRF facility from the European Union, where an important share is represented by green expenditure, we have absolutely to avoid any possible overlap between the two. And this has been the most complicated story for us. I will give you an example later on. What are the categories of expenditure that we have selected and included in our framework? First of all, the renewable electricity and heat. This is a category that we will see later on. In terms of weight in our basket of expenditure, appears very limited. And what is the reason for that? That this is limited only to the fiscal facility for companies that are producing energy from renewable sources and are using them immediately in their production activity. Not other. Was one question that came quite often by investors was, why so little? Because for many other measures that are present in the Italian legislation, there is some direct link with the pay of bill for the energy, and there is a different source of financing. So only this part remain available in our basket of eligible expenditure. There are, on the contrary, an important expenditure that is a fiscal expenditure, because again, it is a fiscal incentive, is for the renovation of buildings, for which in Italy there have been several waves of laws. And this is the second important quantitatively category. There are the transport that until now has been the first one with a percentage of over 40%. And there is the category of expenditure to prevent pollution, and the use both in the soil, in the air, in the marine pollution, and the circular economy. And another category is the protection of the environment and biological diversity. This has been particularly appreciated by investors because not all the sovereign issuers in Europe are covering this area, and this is quantitatively the third one after the 2 and the 3. And finally, the research that is addressed to all the activity in the research that are covering environmental areas. And just, this is quite a full slide, but just not to complicate too much the explanation, this is just to give you how complex is the process of defining the portfolio of eligible expenditure. First of all, in the red cycles, you will see that we start from the budget and the expenditure in a different chapter of the budget coming from the General Accounting Department. And there is, moreover, in this way, we can discriminate what are the green expenditure. And there is also a dialogue with the Department of Finance, because you have seen that 2 categories are represented by fiscal incentive. This on one side. All is converging in the task force in the Treasury Department, of which I'm a part, that is managing all this type of activity. There is, moreover, the Committee for Green Bonds, Interministerial Committee for Green Bond, that is put in place by the budget law. And apart for the regular meeting in the committee, where there is a representative for each minister present there, each ministry is sorry, there is fact that is important to dialogue directly with the responsible unit in every ministry to discuss directly with them. But not only ministries, nevertheless, because quite soon we realized that, for example, with railway companies and RFA, it was important to establish a direct communication without any intermediation. And again, one of other sector where we have to avoid absolutely double counting is the proceeds of green bonds issued by us and ours. But the dialogue has been and moreover, there is an important collaboration that since 2 years we have established with the CDP, Cassa Depositi e Prestiti, that has a very well-staffed group of persons that is expert in the assessment of impact on the environment, and is provide us a support with the use of specific models for making this kind of assessment. And okay. What has been the market response of this activity? It has been very, very positive. We started with a 24-year maturity in March 21, that received a very high demand. record demand that for the moment it was the larger ever green bond issued. Later on, there were others that overcame this level, 8.5 billion, with a demand that was almost 10 times the size, final size of the issuance. And this occurred quite frequently. So in each syndicated transaction, we noticed a very large demand, very, very, very significant, as you can see in the table of BTP Greens, has reached 58.5 more or less billion of euro. The demand is not large only, but it is also very qualitative. In this chart, you can see how different syndicated deal, only for that and not for the tapping auction, we have this breakdown available, have been covered by different type of investors. It is important also to notice that in the last two transactions, those taken in this year, there was an increasing share of dark green investors. What does it mean? That those are investors that are privileging strongly the investment or exclusively in green assets. If we consider others that are not so addressed with this type of bond, but typically there are the American ones in recent times that cannot claim that are so committed in this area, rise to respectively 53 and almost 69%. So this is quite important as a signal of appreciation from the market. And apart from the type of investors, there is also available the breakdown by region, about the geographical areas. In general, there has been always a predominance of foreign investors, with the major weights in the European one, but also in other regions of the world. And what is the position of Italy as an issuer of green bonds? We are the third one considering the sovereigns, and the fourth one if you add the EU Commission with the bonds issued under the Next Generation EU program. This is an overall breakdown of our activity. You can see that we have also done some reopening of existing bonds because we have a problem of excess of demand in comparison to what we can issue. Be fully certain that there is not a risk of double counting. In reality, in the state budget, there are a larger amount that is potentially green, but we cannot consider all of it for two reasons. One is essentially because when there are transfers to local authorities, is very difficult and in many cases almost impossible to receive punctual reporting regarding the effective use, especially with the time necessary for an annual reporting. And the second is of a possible problem of double counting that we can be, especially until the PNRR closed is very difficult to predict, also because there have been several revisions that make our job quite complex, and Stefano knows very well this problem. In this chart there is the breakdown of weight of different categories, and the dominance of the transport that is the yellow bar is quite evident, and also the energy efficiency that is the red one. The dark gray is the category of protection of our environment, and the other two. In conclusion, what investors appreciate the most in our activity? First of all, they are aware that the basket of eligible assets cannot be limited to specific project of investments, like the taxonomy, on the contrary, has been built. They are aware of that, and this is, on the contrary, they appreciate certain operational expenditure, like the maintenance of parks and the research, that typically doesn't meet so well the taxonomy. As I mentioned, they appreciate the transparency in the communication. Just to give you an example, in the second report, because in the meanwhile occurred some double counting with certain expenditure that went unexpectedly under the PNR, the program financed by the EU, we were forced to revise something in the first allocation and replacing, and we clearly explained what were the removed project and what was there were replaced. This exercise of transparency has been largely appreciated. And the top of maximum of care that we used later on didn't provide the necessity of repeating this exercise. And moreover, they also appreciated that every year we are fine-tuning the methodology of assessment, in particular of the impact section, and also they understand that there is also a progression in collaboration with other ministries and other stakeholders. That is not so obvious. In the beginning, at the beginning, there was some difficulty to make understand that a lot of more information, and also this has been well understood and appreciated. Some anticipation on the report that will be issued next week, I believe, on next Wednesday. Just to explain you how is complex the approaching to the compliance with the EU taxonomy. There is, this is quite summarized. There is a detailed analysis at the beginning of all the portfolio of the financial expenditure. We are going more in depth when a chapter is mixed in terms of functionality. So we are going more in sub-chapter and in some cases also in single line of expenditure. And the classification national standard, the COFOG, and to verify the not alignment, because to speak about alignment, we need to verify all the elements. This implies also the DNSH requirement, do not significant harm in other financial, environmental objective that has been possible only partially and especially for project from railways that have a project that have built since the beginning with all the analysis for providing it. And there is a match with the classification of economic activity, the European wine, NACE. And moreover, also a combination with the EU taxonomy classification in the taxonomy compass. So we can tell at the end that in the report that is coming next week, there will be 100% of the resources that are potentially respecting the environmental goals in the taxonomy and are fully compliant with the minimum safeguards. 79% is meeting the substantial contribution criteria of the taxonomy, and 60% could be defined as perfectly aligned with the taxonomy, also with the assessment of the NSH principle. So, conclusion, what are the points of strength? Again, the transparency in the communication and the care of ensuring accurate reporting. The ability to coordinate a multiplicity of public sector factors that give to our country a perception more positive than the common, I don't know, press and the media perception. The improvement year by year of gathering deeper and more qualitative information, the commitment to be a stable presence in the market and in the sector with the possibility after the end of a PNRR to increase the size of our issuance, and also the commitment in continuing to support the liquidity. And this has been done especially with the auction, the reopening tap that we have done of existing BTP Green when there have been some tension in the secondary market. In such a manner, apart from the greenium that at issuance some small greenium is present, we noticed that there are no difference between BTP Green and others BTPs, but when there was some lack of availability in the secondary market, the possibility of making some tap in auction has helped also to foster the liquidity of these bonds. Sorry, I stop here. I hope
Thank
not
you,
have
Maria.
taken-
Thank you so much. L'ultimo intervento, do la parola al professor Oriani, Dean della Luis Business School. Prego, Raffaele.
Devo aprire qua? Aspetta.
Aspetta, andiamo sul... Questo? Vai.
Okay, so good morning and thanks for the invitation. So here we are moving from the public to the private sector. And so when Renato and Francesco invited me to the workshop, I thought that with the colleagues Francesco Fasano, Francesco Cappa and Samuel Vin, we were already working on a paper on green bonds that we are presenting around in conferences. We just submitted to an academic journal, so it was the right opportunity to discuss it here in a context where we are talking about bonds and sustainable finance. I don't want to spend too much time on this. We know how important green bonds are. Maria has essentially talked about that. I just clarify that when we talk about green bonds in our paper, we refer to the ICMA definition that Maria was citing. So we are talking about the same security, simply this is about, these are private issues and not public issues. So if you look at the economic and financial literature on green bonds and their impact on company performance, we can see pros and cons. The pros are the signal effects of issuing a green bonds in terms of credibility of the firm, in terms of commitment to the environment. Typically lower cost of financing, so the interest rate is lower, and lower risk in the sense that there is a part of literature that claims that issuing green bonds is reducing overall the cost of capital of the firm. On the other side, we have costs that are related to the cost of monitoring, the higher risk that bears on the issuer side for the management of the underlying green-related projects, and the need of getting third-party certification that is an additional cost for the firm. So say that the question is, can we say that when a company issues green bonds, its economic performance will be better? It's assessed by stock market reaction, and this is the question we ask basically in this paper. So when does green bond issuance benefit firm expected performance? When we measure clear expected performance is abnormal returns in the market after the announcement of the issuance of the green bond. And in particular, as there is mixed literature and mixed results on this topic, we focus on three possible contingencies that are the sustainability performance at the moment of the issuance, that is measured by the ESG score. Second, the actual economic profitability of the firm at the moment of the issuance. And finally, the fact that the underlying project refers or not to green technological innovation. Skipping the theory, but just a few words. We have three theories that are on which we base our hypothesis. Signaling theory, where we recognize the emission of issuance of a bond, of a green bond, as a signal to the market about the commitment of the firm on contributing to the environment. Legitimacy theory, where green bonds can improve the legitimacy of the firm in terms of sustainability, but there is also an opposite effect that might be related to the attention-based view, where an excessive attention to green bond sustainability and climate-related issues might bring a perception in the market that the company is not focused enough on economic performance and too much on sustainability. So we see pros and cons coming from the literature, and based on that we have three hypotheses that I try to summarize. The first hypothesis is that there's a U-shaped effect between the level of sustainability performance, the ESG score, and the reaction on the stock market at the moment of the issuance, because if the company is not performing well in terms of sustainability, then the market receives the issuance of a green bond as a very positive signal. The signaling effect is reduced when the companies improve its sustainability performance, but when the company is already very high in terms of sustainability performance, the issuance of a green bond is a null or even a negative effect, because this is signaling an excess of attention to sustainability as compared to economic performance. This inverted U-shaped relationship is attenuated in case, that's hypothesis number two, the company is performing well. So a company that is performing well is, in this case, investors are less concerned about the fact the company is issuing or not green bonds. And so the effect of green bonds issue on expected performance is less important, less relevant. Third hypothesis, the inverted U-shaped effects of sustainability performance on the stock market reaction to the green bond issuance is negatively moderated by the fact that the project, underlying project, is not related to green technology innovation. So if the green bond is not financing a green technology innovation project, the market is perceiving that less positively. Okay, so this is in a nutshell the set of hypotheses we test empirically. So we take a sample of green bonds issued in the US. We have 582 issuances, and clearly we performed standard event studies. I don't want to say too much about that, just measuring cumulative abdominal returns in the period of -10, +10. With respect to the date of announcement, we have also robustness checks with different time interval, then the results do not change significantly. And so this is our dependent variable. So we look at the reaction of the market when the green bond is issued, and the three independent variables, and then we have a set clear control variables. I'm not going into details because they're quite standard. Sustainability performance was processed by ESG score, hypothesis number 1. Profitability is the first moderating variable, is proxied by return on equity, and non-technological innovation is the second moderating variable, is codified as a dummy variable which is equal to 1 if the project is not related to green technology innovation, and so is related, for example, to capital expenditure in general, not specific reforestation, general purpose, and so on. So these are the results, but I would like to summarize what we find in terms of our results. So here we have the first hypothesis, the SG score overall of the company, and this is the stock market reaction at the moment of the issuance of the green bond. So what we can see is that when the SG score of the company at the moment of the issuance is lower, there is a stronger positive effect that is reduced as the SG score improves, and there is a threshold beyond which the issuance of the green bond brings a negative signal to the market, and so the effect starts becoming negative. Then clearly we need to understand how this U-shaped curve is moderated by the two other variables, and so we have the other two graphs on the right. In the upper right corner, we have the effect of the return on equity, and so what we see is that the high return on equity is in the curve where we have the squares, while the lowest return of equity of the issuing firm is in the curve where we have these circles. Okay, and so you can see that the impact of sustainability performance is much stronger, much more relevant for companies that are lower economic performance, is much flatter for companies that have a higher economic performance. So this means that if a company is a high economic performance, the investors are less concerned whether the company is issuing or not a green bond. And finally, what we see for green technology projects, this curve is the curve where so this curve, that is the rhombuses, it's not clear rhombuses, but anyhow, is the curve where you have, so these are circles. So the circles, this is the curve that refers to the projects that are not related to technology, to green technology projects, while this curve with the rhombuses is related to the projects that instead are related to green technological innovation projects. And so what we see is that the effect is clearly positive with the same shape as the baseline case for those cases where the green bonds is going to fund a green technology projects, while the curve shifts for the projects that are not related to green technology. So this means that investors in the market are clearly, evidently considering a green bond that finances green technological projects more credible than the other projects. So these are basically the conclusion of our papers. And what we claim in the paper is that there is not an ex-ante predetermined effect of the issuance of green bonds on the the stock value of firms. This depends on contingency. In particular, the effects is depending on the level of sustainability performance, and they're moderated by economic performance and the type of projects that are funded by green bonds. So this is a first indication of the conditions that might affect the value created by green bonds for finance manager within corporations. So now the paper is under review, and we are seeing what is going on, what is happening next. Thank you very much.
Thank you very much.
May I add a consideration that I missed before seeing? What the Treasury noticed is around 20% of investors in BTP Greens that never bought BTP before. So for the Treasury has been an enlargement quite significant of the base of investors. So just that.
Thank you, Maria. Thank you, Raffaele. Thank you. Now we can start with the panel. So please invite here Marco and the other speaker of the panel. Thank you. Later we have a lunch outside, so we can wait for this. Allora, riprendo. Mettiamo, dove volete mettere? Se te ti metti qua, vai. No, mi sa manca la sedia.
Okay, while the speakers get ready for the speech, I'll introduce this round table that is about the relationship between ESG and credit risk. So we are going to deep dive into the link between credit risk and ESG factors. We already mentioned some of the issues during the previous speech. I think that Dr. Rizzo just left, but he mentioned, for example, quality of collaterals. When we try to find the relationship between ESG factors and credit risk, but then we also mentioned signaling theory, so the idea that when you provide a nice and good ESG scoring, you are signaling that your commitment toward investments that are going to foster your transition toward a green economy or social factors or whatever it matters in this sense. So I think that we are going to look at the relationship between credit risk and ESG from many perspectives in this round table. The role of the chairman is to keep time. The idea is that I'm not going to waste time myself. I will So the stage is going to be yours in a second. I just want to tell you that since this round table comes just before lunch, I'll be very strict. So I will follow the order of the program of this conference that I'm very happy to be invited to, and I'm very happy to sponsor as one of the directors of Centro Arcelli per gli studi monetari e finanziari, CASMA, for Luis Guido Carli. So I'm very happy to be here. I'm not wasting time anymore. So the stage is yours. So the first speaker is Simone Budini, that is going to talk us about humanistic ESG, financial impact of ESG risks.
Thank you very much.
Please.
I knew I had a few time, so
15 minutes.
15? You sure? So we've got an hour.
Ah, yes, an hour for
For everyone.
Yes. Okay.
I thought just 5 minutes, so don't worry about it. It will be better for you. I would start with a question. Would you buy a cake with the risk of having a bad cherry, just a bad cherry, if you're sure that the cake is good? I think maybe we could. Would you buy a baba with the risk that the ram inside the baba isn't good? No, you wouldn't. That's the difference between CSR and ESG. CSR was, we remember it, was a nice to have. If you had it, good, and if the cherry wasn't good, wasn't a really critical issue. Failing on ESG today is like having the risk of buying a baba with a not good ram inside it. Can cause legal penalties, investor withdrawals, loss of partnership, and real financial damage. I'll show you just 3 very famous and little examples. I don't know if you already know it. The first one is the PG&E. It was actually a major utility company in California. In 2010, one of PG&E's power lines sparked in a massive wildfire. It was the Camp Fire, and it became the deadliest and most destructive wildfire in California's history. 85 people died, entire towns were destroyed. But this wasn't a natural disaster. It was a failure of environmental risk management. The company had ignored years of warnings about maintaining its infrastructure. The result, the financial impact, PAG's lost 90% of its stock values. It paid more than 30 billion in compensation, and it failed for bankruptcy. The second case, it's pretty famous, this one too. It was a social case. It's Boohoo's, the fast fashion brand from the UK. In 2020, a new investigation revealed that some workers in their supply chain in Leicester were being paid only £3,500 per hour, less than half of the legal minimum wage in the UK. And this sparked a huge public outcry. The retail partners like ASOS, Zalando, and Next stopped working with Boohoo. Investors pulled out, and Boohoo's shares price dropped by over 30% in a matter of days. 30% in a matter of days. And this case shows us how ignoring labor rights and supply chain ethics can have serious financial consequences. It's not just being nice. It's about being accountable and financially smart. The third and last case, it's pretty famous only here in Italy, we know it. It's the pink case. Per antonomasia, I don't know how to translate this one. It's the pink case, please help me to translate the pink case per antonomasia. It will be signed the history. Fenice Sorelle is the company behind influencer Chiara Ferragni brand. In 2022, her company partnered with Balocco that sell a special pink Pandoro cake, suggesting that part of the sales would support the children's hospital. But the donation had already been made earlier and wasn't tied to the actual sales. So this was considered a misleading advertising. As a result, Fenice was fined 400,000. The company lost major brand deals like Coca-Cola and Safilo, and it saw a 30% drop in revenues in few years. There is an ongoing criminal investigation, actually, and this is a lesson in governance and ethics. Even promotional campaign must be transparent and credible, because we trust breaks, money follows. And there are a lot of different cases. I think we already know the environmental case of British Petroleum, the social case of Rana Plaza, and the governance case of Meta. How do you say Meta or Meta? I don't know, actually. It's Meta? 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 Meta, okay, thank you very much. And this brings us to the idea of the double materiality. That is, the concept of the double materiality is so much important. A key concept in the Corporate Sustainability Reporting Directive here in Europe, double materiality means looking at sustainability from two angles. The impact materiality that we already knew, how a company affects to the environmental and society, and the financial materiality, that is how those environmental and social issues affect the company. Let's focus on the second part, the financial materiality. Financial materiality asks, can climate change, inequality, or poor governance put our business at risk? The answer is increasingly yes, it can. So let's take climate change, for example. There are two types of risk companies need to manage: mitigation risks and adaptation risks. Mitigation risk is how the company plans to reduce its emission, to adapt its supply chain, or to shift to cleaner technologies. But adaptation risks, from the financial point of view, maybe is more interesting because it answers on how the company prepares for climate shocks like floods, fires, or heat waves. Failing to mitigate emissions can lead to carbon taxes, to regulatory penalties, or investor exclusion, but failing to adapt can lead to supply disruption, to insurance losses, and even bankruptcy, just like PG&Es. So, financial materiality forces companies to connect the dots between sustainability and survival. And maybe, I think it was the time, so that's enough from my point of view. What are my final takeaway in closing? ESG risk is now must be called as financial risk. If few times ago we considered that sustainability was something to be good, I think now it's time to think it as something to be cool, if you let me this way. And that's it. Thank you very much.
Thanks a lot. So we are going from double materiality to the use of AI in credit risk. So Gabriele Sabato is going to tell us about the role of AI in shaping the relationship between ESG and credit risk.
Yes.
Please.
Great, thank you very much. And good afternoon, everyone. My name is Gabriele Sabato. I'm the co-founder and CEO of Wiser Funding, the company that Professor Altman mentioned before. We started 7 years ago, and I go back definitely to a financial risk, which is credit risk. But in particular, how we use artificial intelligence. I mean, today has been a lot about ESG, a very hot topic across the world. And obviously, AI, artificial intelligence, is the other hot topic across the world. And a lot of what I'm going to mention here in these 10 minutes applies to everything, because AI is now, we know quite well, behind pretty much everything we do. Okay, so this is application to credit risk, but we've been discussing with Professor Baldi how it can be applied also for ESG risk. And in general, AI is a way to teach machines how to think like us, okay? And when they can think like us, they can do the same things that so far only humans have been able to do. That actually seems scary, I know. Everywhere I go and I say this, they say, okay, well, then my job is gone. Well, potentially many jobs we know will be gone, but at the same time, a lot of these jobs are the one, I would say, let me say, most boring, like data entry, like all these things that actually machines can do better than us, and probably we shouldn't be using humans to do. And now we have that opportunity. So let me tell you a bit more. I mean, again, this is something Professor Altman mentioned. We met in 2003 when I was a visiting scholar at NYU, but we only started the business after the work with the Borsa Italiana, the Italian stock exchange. Today, Wiser Funding is a global business. We have more than 60 clients globally. And I guess of all these numbers, I mean, Professor Altman mentioned the number of models and all that, but the one I'm most proud of is the 3 billion. So thanks to our technology, our clients have been able to lend more than 3 billion last year to small and medium-sized firms. And we all know how important that is, right? That ability to lend. It's not just about lending. That's one way to use our technology. But in general, it could be supply chain risk, could be any time that you want to invest, to insure, or work with another company. How good would it be if we would know that company well enough? Before, when we were less digital, maybe we would invite them, we would meet them, we would go out for breakfast, for lunch. So that human interaction today could be seen as a good thing or a bad thing is kind of gone. So a lot of times you only have digital channels to learn more about who you're dealing with. And so you need to be able to use the data available. There is a lot of data out there. Be able to source, to gather that data, process it in a way that then machines can help you deal with, you know, your suppliers, your clients, your borrowers. And this is exactly what we do now. Specifically here, like SME lending has been a big problem across the world. Slow decision making. I mean, everything today needs to be digital, needs to be real time. We know this, right? It applies to many different things. And obviously, again, behind all that, you need to have the data to allow you to take decisions quickly, to understand who you're dealing with. And that's really what we do at Wiser Funding. Digitalization is an opportunity. You can offer more products, you can scale up faster. So obviously that's the objective. How we do that and what's the role of AI? Again, Professor Altman before mentioned he was quite skeptical when we started, can really AI add something? But in reality it's not AI that adds something. AI is just a tool that is used to gather data, unstructured data. So imagine if you want to know management experience, again, of a company, before you would, again, meet the management, and your brain would be able to understand how experienced they are, how good they could be in leading that venture. Well, what if you want to teach machine to understand the management experience of the management of a company? We can do that. You can allow the machine to understand, okay, what's the age, what the experience, what have they studied. They can collect all this information because it's available, and then again, that's the way you train AI models, understand how to put all this together to come up with their own view. It's a good management experience, medium, low. And so this is exactly what we did. We've done it for many variables that then we have added into our credit risk models, and that's, as you can see, increased significantly the accuracy of those models. This is a bit of the data, because behind all this is data, right? You can see the type of data we gather. Obviously, we start from financial. I mean, we all know, Professor Altman, Z-score model was based on 5 financial ratios. So we definitely leverage on that. It's so important, still very important financial information. But then we have added everything else. You can find, I mean, I'm sure any of you, if he wants to know more about a company, first thing he would do is probably go to Google, right? Google search, and then look for news about that company. Maybe look at LinkedIn profile, their website. Now, again, you don't need to have a human to do all these things. A machine can be trained to go to their website, capture the keywords, capture news, sentiment analysis, and all that. And that's fascinating, to be honest with you. Banking information, trading information, it's all out there. You just need to know where to look for and how to process a very, very large amount of real-time data. Once you do that, then you can see, you can summarize this data on the other side into financial metrics, again, probability of default, loss given default, expected loss, credit limit. So metrics that can really help the management to take faster decisions and improve the efficiency of their processes. So can AI help? Definitely, it can help. There are many different types of AI. I mean, probably what everyone knows is ChatGPT, but that's just one type of OpenAI. There are many other tools today out there that can support, and it's just a question of training these models to do what you want them to do, and learn like the same way you would teach a kid, a baby, how to do different things. And so that's the big, you're probably familiar. This is something that Professor Altman mentioned before. Artificial intelligence has always been around, right? Machine learning is a form of artificial intelligence that was around 60 years ago. When we started 7 years ago, there wasn't ChatGPT. Again, we were using natural language processing modules. Maybe many of you have got Alexa at home. Alexa's been around for a long time. You can ask Alexa to do something, switch on the lights, and that understanding of speech is artificial intelligence. This is all application of artificial intelligence. Robot advisory, language recognition, real-time translation. I love that one. So many times our clients receive PDF of accounts in different languages. And now we just upload it. Our models read any language. Alphabet is a more difficult thing. We're still training to read, Arabic or Greek or Japanese. That's more difficult, but they can read any language. It doesn't matter for the machine what language is that, French, Italian, German, it doesn't matter. They read, they understand what they are, they reclassify the accounts in real time. This is amazing, to be honest with you. And so these are all the applications, and again, that's how we really use in risk for, model development, model validation, but most importantly, gathering and processing large amount of data. And this can be really used in many other, also non-financial risks. I'll close there. Thank you very much for your time. Thank you.
Okay, so if ESG and AI were not enough to make our environment cumbersome, we are going to add behavioral stuff. So please, Enrico,
okay, so
the stage is yours.
Thanks.
You are going to talk about behavioral risk management and lending, so make things more difficult if you can.
Yeah, sure. Well, to be shorter, I eliminated the part of lending, so stay in less than in 10 minutes or so. So the subtitle is Human Factors Amplify or Mitigate All Other Risks. So I paid a lot of attention to the previous two presentations, and I think that mine intersect pretty well, and I'm pulling both of them somehow together. So thanks, by the way, to first of all Renato Giovannini for inviting me to this seminar. Also, of course, to Francesco Baldi, and all Marconi University, my new university since last November. All right, so let me start from here. You may recall the Fukushima disaster back in March 2011 in Japan. Now, while Professor Budini was presenting before, he mentioned the or BP oil spill disaster back in 2010, April 2010, if I recall well. I actually have a paper with a friend and colleague of mine, Hirsch Sheffrin, that is actually my master, one of the pioneers in behavioral finance, been working on the behavioral part of that disaster. And he wrote a book eventually that I will mention today that is called Behavioral Risk Management. And one of the cases that he discusses is actually the Fukushima disaster. And so what happened? Actually, you may recall the disaster, but I don't know if you know that 3 years before, in 2008, the TEPCO, the company managing the Fukushima Daiichi nuclear power plant, actually conducted an internal safety simulation. And that simulation basically told us a significant tsunami risk, forecasting waves potentially exceeding 10 meters in height in the event of major seismic event. And we, of course, know how seismic is Japan, but in case of major seismic event. Now, the company, TEPCO management, chose not to take action. And specifically, they did not raise the height of the seawall to guard against such a scenario. The emergency generators and backup power systems that are crucial for maintaining cooling system in the reactors remain installed in low-lying areas that were vulnerable to flooding. Eventually, and unfortunately, on March 11, 2011, a magnitude of 9.0 earthquake, so a huge, there was the greatest East Japan earthquake in history, so a huge earthquake, actually provoked a devastating tsunami, as you may recall, with waves 14 to 15 meters high. And of course, that was exceeding the level anticipated by the previously ignored internal simulation. And this tsunami overwhelmed the plant's existing defenses. Severe flooding knocked out primary emergency power supplies. Loss of cooling capacity basically ended up in the core meltdowns. And of course, the consequences are quite famous, unfortunately. The release of radioactive contamination, mass evacuations, causing catastrophic environmental and public health impacts. Now, this is Hirsch. Been honored to have a conference last Friday at the Bank of Italy. It was one of the keynote speakers. So he wrote this book, Behavioral Risk Management, basically mentioning several cases and adding the behavioral finance dimension. I don't know how many of you are familiar with the behavioral approach to finance. It's been there for quite a while, but basically is the interaction between psychology and finance and adding the human factor somehow. So in the book, in the description of the case, basically Hirsch was mentioning the TEPCO CEOs, Masataka Shimizu, that was actually notably absent from public view during the critical early days after of the crisis after the disaster. And actually, it seems that this disappearance was not simply avoidance of the public or poor public relation, but it signaled a deeper biologically driven behavioral response to acute crisis stress. So basically, there was seems to be a dramatic surge in cortisol, known to be in the so-called stress hormone. It's a hormone that plays several roles, but also in high levels, it provokes high stress. So what's the idea here? To add up the two things we were talking about. So I'm very, I'm kind of a sponsor by AI. I love AI, and what it can do is kind of magic, but it's really great. And integrated with the human factor. So what's the idea? I mentioned here a phrase from the book written by Hirsch. Technical systems fail when human decision makers ignore what their own models predict. Okay, we've seen several cases of this happening. My memory goes back to the LTCM case, the long-term capital management case, so on and so forth. All right, so not going too much in details, but the idea is you don't want to face also, or you don't want to forget about another risk that we're typically not paying so much attention. So we're typically, as economists, we're typically used to deal with financial risk, several kinds of risk, credit risk, ESG risk, whatever. Sometimes we may forget to pay enough attention to the risk that comes from people, from human beings. In such a crisis, you don't want the CEO of the company, and in that case of a nuclear power plant, to simply disappear because it has a high level of cortisol in his blood. Okay, we want people, key people, to be there when we need them. Okay, so typically in these cases, individuals often revert to a primal survival mechanism, the so-called, we're used to say fight or flight. There's a third F, the fight, flight, or freeze. So the guy simply froze actually. So he didn't know what to do, and it didn't do that. It simply disappeared. Yeah, it's kind of thanatosis, like exact. So we don't want that, of course. So actually, there was a independent investigation by a Japanese government-appointed panel that described the Fukushima disaster explicitly as a man-made catastrophe. Actually, going back to the BP oil spill in the Gulf of Mexico, also we call that a disaster, but that too was a homemade disaster, or at least it was intersection. It was kind of an unfortunate intersection of causes, but the human factor was a key factor. Also, that case, BP, for example, was cutting maintenance costs for years and years here, and sooner or later you get a disaster, and they got another couple before that. All right, so there were several behavioral issues in place at the time. A lot of overconfidence. Overconfidence means confidence is fine. We are confident in our skills, capability. If it is too much of a good thing somehow, overconfidence typically leads to underestimate risk. Okay, there was confirmation bias, the so-called myth of absolute safety, that kind of pervaded the Japanese culture, especially with respect to dealing with earthquakes and so on. There was short-term thinking, there was cost aversion, there was myopia, not looking at long-term consequences. So I think that this case, the Fukushima disaster, have a lot to teach us in terms of preventable events, management to overcome cognitive and behavioral biases, and proactively invest in appropriate risk management that also consider the human factor. So again, a lot of behavioral issues here. I'm not going into that, but the powerful lesson is managing creating ESG risk and any other kind of risks, considering human factors. So let me switch to, for example, all the committees we can consider, risk management committees or credit committees. Think about it, they're composed by people, by human beings. Would they behave differently under such stress? And I think everybody in this room knows about stress and overall working too much, so on and so forth. Okay, so even the more sophisticated risk model can be undermined by cognitive and physiological factors. So I think AI, artificial intelligence, can play a huge role, given the power of managing a huge amount of data and in also incorporating behavioral factors, behavioral data, human-centered information about data, and that applies to ESG risk, that applies to credit risk, and many, many others. So the idea is add human diagnostics alongside value at risk, probability of default, loss given default, and many, many other things. The last book by Hirsch, by the way, I invited you to read both, Behavioral Risk Management. If you don't know, the last one is The Behavioral Economics and Politics of Global Warming. Been working a lot on ESG issues, but even more on global warming, climate change, or climate crisis, as we want to call them. Again, a lot of stuff. I'm not going to the details to stay my time. But the idea is, for example, to treat ESG metrics
like the Fukushima seawalls. Build them before the wave. That's basically the idea. And some toolkit, risk management, behavior risk management toolkit that we can use are behavioral risk audits, kind of bias mapping workshops. Last Friday at our conference in Bank of Italy, also Cass Sunstein, that is the co-author of Richard Thaler in the book Nudge, and many others, were talking about the sludges, okay, this country of nudges, kind of, which are the cognitive obstacles that do not allow to reach our objectives. Devil's advocate and diversity mandate, pre-mortem scenario reframing. Ask, it's 2028 and this is ESG alone blew up. How did we miss it? Probably not, because in 2028 there will be 60 years after the seminal pioneer work by Professor Altman, so probably we won't get into that trap. Living scorecards, green more, tomorrow nudge. So if you probably know the Save More Tomorrow nudge by Thaler and Guillermo Bernalfi, there's a kind of a green more tomorrow. We can impose an automatic 5 BP spread step up annually unless borrow it's an ESG target. Okay, so key takeaways. Technical models may fail without human factor checks. Behavioral scoring and AI widen inclusion and sharpen risk signals. ESG and climate risk are hostage to cognitive bias, so we have to manage the culture, not just CO2 metrics. And action, we can embed shared frames or also other scholars, behavior frameworks, behavior checklists beside every risk matrix. So a couple of phrases to wrap up and close. Food for thought. Models tell us the odds. Behavior tells us which odds we'll ignore. And next border crisis, we do not rely on spreadsheets, or not just on spreadsheets, or do we also have a plan for cortisol? Thank you very much.
Thanks, Enrico. So last but not least, Professor Alessandro Gennaro is going to talk us about exploring business sustainability and resilience from a financial perspective. Stage is yours.
Thank you. Let me first say that I am truly honored to be here and have the opportunity to meet Professor Altman. I studied about from Professor Altman, so I would like to thank you, Professor Giovannini and Professor Baldi, for inviting me and stay here and sharing my idea about the sustainability, the intersection between sustainability and business resilience from a financial perspective. So I'm gonna touch 5 main points in my brief speech. I would like to talk about, introduce the concept of business resilience and business sustainability. Then I'll try to combine resilience and sustainability, adopting a financial perspective. Then I spend some words on the role of financial management, and I'll try to define some research perspective. So let me introduce my speech with a premise. As probably all of you know, the landscape of corporate value in 2025 is being decisively shaped by the ESG factor, the environmental or social or governance factor. So we can say that ESG is no longer a peripheral concern, is at the center on how investors or regulators or consumers evaluate companies, evaluate investments, evaluate investment opportunities. But let me also say that there is a sort of differences between the aspects on which scholars and practitioners are focused on today, while academics, in my opinion, still question whether ESG factors influence corporate financial performance, since there are no definitive now converging evidence on that. Entrepreneurs and managers are addressing the same question, but trying to find the I try to find how the ESG factors, the ESG concerns can influence the business, the performances, and how they can leverage the ESG factors to enhance the performance of a firm. So, after the pandemic crisis following the COVID-19 outbreak, arose another trending topic that is the resilience, the business resilience. So, in the speech, my speech aims to explore the intersection of business sustainability and business resilience from a corporate finance standpoint. Therefore, I'm going to address two main questions. The first one is, does sustainability and more specifically ESG factors contribute to corporate resilience? And the second one, the most interesting, in my opinion, is how can financial management contribute to corporate resilience by leveraging sustainability? So in today's talk, I will explore how and why ESG considerations, ESG factors, ESG concerns contribute to financial resilience, and I'll try to recall briefly the financial literature and try to propose a sort of conceptual framework. At the end, I formulate some future research line. So let's get started with the first point on our agenda, which is about the business resilience. Exploring the academic literature, we can find that there are several different definitions of resilience. The concept of resilience has been applied in different contexts, starting from 1973, and as you can see in this summarizing table, the concept of business resilience, the resilience has been applied in the context of physical systems, ecological systems, socio-ecological systems, disaster management, organizational, engineering, and so on. But just to summarize, what do we mean by business resilience and what do we know about it? Let me say that at its core, business resilience refers to a firm's ability to anticipate, the firm's ability to prepare for, to respond for, to adapt to incremental changes or to sudden disruption that come from economic or financial crisis, come from market volatility, come from geopolitical tensions, environmental issues, or social upheaval, for example. But what is of interest in my speech is that business resilience can be seen as a driver for value creation in business. This is because health crises, war events, or extreme natural events, geopolitical tension represents exogenous shocks capable of generating economic or financial crisis at a systemic level, adding sources of uncertainty, sources and factors of uncertainties to the physiological factors of uncertainty connected to the business competition, such as innovation waves or technological leaps or customer behavior. Given that the creation of corporate value based on the ability of a company to survive over time by overcoming disruptive disruptive events or turbulences require even greater resistance to exogenous shock, requires even greater adaptability to the new scenarios that arise from the exogenous shocks. So the second topic that enters in my picture is business sustainability. why is business sustainability is so relevant today? As you know, there are several current trends on sustainability, since policymakers, authorities, regulators, investors have put sustainability at the center of their actions. For example, we can remind that our regulations on mandatory ESG disclosures that are coming from, for example, European institutions, such as the Corporate Sustainability Reporting Directive, or UK institutions, such as the Sustainability Reporting Standards, and so on. Also, we can mention the standardization of ESG rating efforts, or the attempt to find a global framework for reporting. We can also mention the shareholding activism or the sustainability-linked finance. These are all current trends on sustainability that that explain easily the relevance today of the sustainability in business field. But the question again is, why is business sustainability so relevant? In my view, the business sustainability is relevant because we can see the business sustainability as a second driver for value creation. As you know, first, social tensions and inequalities have long since started a reflection on the role and aims of firms. Today, climate change and environmental emergencies have enforced this reflection on the role and aims of firms. Let me mention that both of these concerns, social inequalities or environmental emergencies, has been attributed to the drifts of modern financial capitalism. So today the sensitivity of consumers, of investors, of institutions on these issues are very, very high, and pushes to accelerate what is a sort of transition from the economic value maximization that lies on the shareholders' value approach to the systemic value creation, which lies on the stakeholders' value approach. So the creation of corporate values has multiple dimensions, an economic one, as well as social and an environmental dimension. For the company to remain viable over time, no component of the value creation can be negative. Value cannot be created for shareholders to the detriment of the environment or the society, and at the end, the creation of value must be shared among all corporate shareholders. So we have an evolving role, I see an evolving role of the firms. The idea of the company oriented only to the profit and financial performance has been overcome, and today the creation of sustainable and long-term value, integrating financial and non-financial objectives, is a pivotal concept. Disruptive changes triggered by pandemics, wars, energy crisis, natural disasters, or social issues have made it clear that companies must be capable of creating value, resisting and adapting to shocks, but also benefiting the environment and the society. So ESG can be seen as a driver for financial performance. This is a crucial question because about 80% of institutional investors consider ESG factors critical in investment decisions, and also global ESG assets are projected to surpass the $50 trillion by the end of this year, 2025. So the ESG global assets represent 1/3 of all total assets under management. So the main question is there a robust empirical evidence on a positive relationship, sustainability and value? This is a question I'm trying to address, recalling some evidence from the financial and managerial literature. Does sustainability create value is the main question. Specifically, is there robust empirical evidence on a positive relationship between sustainability and value? There are many performing pieces of evidence. For example, in 2015, Friede, Bush, and Bassett performed a meta-analysis reviewing more than 2,000 studies from in a long time span from 1970 to 2015, finding that the search for a relation between ESG criteria and corporate financial performances can be traced back. So we are addressing an old question beginning at the beginning of the 1970s. Findings from existing studies are difficult to generalize, as the knowledge on the financial effects of ESG criteria remains fragmented. Roughly 90% of studies find a non-negative ESG CFP relation, and the large majority of studies reports positive findings. Let me skip these other evidences, but let me also say that there are some doubts that arise from the literature evidence. For example, Cornell in 2021 focused on the relationship between ESG characteristics, investment risk, and expected return, and its main outcomes are that investors attempting to improve performance by tilting their portfolio in direction of companies with high ESG ratings are likely to be disappointed, and this is the first fact. From the point of view of the company, the lower expected returns imply a lower discount rate and thereby greater investment in green projects, but not necessarily these green projects are net present value positive, have net present value, positive net present values if the discount rate was higher, and the jury is still out on whether there is an ESG risk factor. So the third question is combining resilience and sustainability. How can sustainability contribute to business resilience? There are several mechanisms. This sustainability can contribute to business resilience. We can say that sustainability-oriented companies can benefit from a solid innovation potential, reputation, competitiveness, preparedness, and proactiveness. But this, in order to benefit from sustainability, the resilience and sustainability require an integrated approach to business management. Now, I assume the corporate finance perspective, I'm considering the role, I'm addressing the role of financial management, and I'll try to answer this question: how can financial management contribute to corporate resilience while leveraging sustainability? Let me first say that financial resilience can be seen as the capacity of a firm to maintain or quickly recover, first, a stable financial performance, this is the market perspective, and second, a solid financial fundamental, this is the management perspective. I will follow this second perspective, management perspective, since from this perspective, financial resilience highlights the ability of financial management to provide the company with effective risk management strategies and adequate financial buffers such as liquidity reserves and debt reserves. In this perspective, financial resilience can be considered therefore a prerequisite for corporate resilience. And it's about the financial resilience, it's about maintaining financing and investing policies and preserving the ability to make strategic choices in the face of uncertainty. Let me skip this two slides about how sustainability can improve risk management strategies and techniques and can improve or expand possibilities to access the financial markets. And I will. There's no time to explain to recall also empirical evidence on the ESG and financial resilience relationship, but I would like to conclude my speech with some managerial implication. as CFA Institute in 2021 said, ESG integration is no longer optional. It's becoming a marker of managerial quality and risk discipline. So the action plan for CFOs, executives, entrepreneurs, and stability officers can be embed ESG into enterprise risk management and scenario planning, conduct regular ESG audits and aligns with global standards, strengthen collaboration between finance and sustainability teams, use KPIs such as ESG adjusted ROIC, ESG alpha on climate VAR, and so on. Just to conclude, my research perspective are about measuring the financial resilience and on measuring the impacts of ESG factors on financial resilience, and I'm asking if the Z-score or the ZESG score can be useful in this kind of research line. Thank you.
I apologize if I urge you to get to the conclusions, but I had a job. Yes. That, so this is what, yeah.
Can we have a few comments?
Oh, I guess we. No. I guess we can have few comments. I asked the organizers, but I would be glad to hear your comments, of course.
Just
so.
A few. All excellent presentations.
Right.
Let me try to make a few comments. Thank you very much, and thanks for really excellent presentations. Mr. Budini, your examples are excellent ones with respect to catastrophic risk, particularly the PSEG, wildfires, and your Fukushima example. There are several others when you deal with reputation risk and the impact of environmental factors on a company's reputation going from high to disaster and bankruptcy or out of existence. So the whole question of resiliency, Professor Gennaro's expertise, is related to, I guess, the type of disaster or events that could lead to a firm going from a very high level, valuation, essentially to extinction. So I think we, at the extreme levels, I completely agree with what you're saying about catastrophic risk and whether or not it's related to ESG factors. With respect to resiliency, I suggest you also look at a few studies by McKinsey on resiliency, particularly about 4 or 5 years ago, if I recall correctly. And what they looked at were various models that you could use and which ones best forecast the resiliency given a shock. And one shock is certainly a wildfire or a tsunami. But another type of shock is economic collapse of an economy, like the great financial crisis of 08-09. And that is much more of a, I wouldn't say almost a gradual question. What companies will survive a financial crisis and which ones won't? And that is much more of a granular or linear relationship rather than binary 0-1, you die or you survive. So there's two types of resiliency. One is to your type of risk, and that is catastrophic. And by the way, there's another wildfire example, Hawaiian Electric, the wildfires in Maui, Hawaii, did not collapse the company, mainly due to bailout on the part of the government. which didn't exist. The state of California did not bail out the big utility there until after they went bankrupt and had to preserve value for creditors. So you might want to look at the McKinsey study. It's self-serving in my part because Z-score was one of the models that were used to measure the resiliency of companies. And I've always argued that in a disaster, in a economic downturn, the firms that are most resilient to upsurge once the catastrophe, once the environment or the economy begins to recover, are the ones that survive the crisis, and the ones that fall the most but still survive do best in the recovery. And that's the mantra of distressed investing. You want to invest in a company that suffers a lot but still survives, because in the upsurge they outperform the average company. So those are just some random comments. Obviously, my colleague Gabriele Sabato, I can't say it was a wonderful presentation because he's talking about our company. But at the same time, we are learning so much about these AI factors and how much it can, it's almost like a before and after. How much does it contribute? It's a really good test case in terms of accuracy levels or whatever the objectives are. Thank you.
So I think speakers really appreciated the comments from Professor Altman, very insightful and helpful as usual. So I wish to thank you all for being here. I was not one of the organizers, so I just take credits for that. So I thank you all, and I wish we learned a lot. I found all the contribution very interesting, both from academic perspective, from practitioners, from institutions. So I really was captured by your presentations, and I'm very glad I was here. And the organizers tell me to tell you that there is a light lunch upstairs. So if you want to go and have something to eat, you are free to go now. And thanks a lot, and I hope we can meet again talking about these interesting topics.